locals in research and development and invest $1 billion in Indonesia. Former Republican presidential candidate Vivek Ramaswamy is running for governor of Ohio. The 39-year-old Ohio native is vying to succeed fellow Republican Mike DeWine in next year's gubernatorial election. Ramaswamy had been named by President Trump as the co-head of the Department of Government Efficiency alongside Elon Musk before he withdrew from that role. Trump endorsed Ramaswamy for governor in a post on Truth Social. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. More from Danny in the next 30 minutes or so. Up next on the program, the bond rally continues.
The underlying conditions that we need for yields to come down, for growth to go back up. 10 years come down, or rates have come down every week since Donald Trump's been president. So, if we can continue that for 52 weeks, that'd be great.
Well, it continues this morning. Yields are down by close to 8 basis points on a 10-year. Up next, Tom Titsouras of Strategas.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together. And that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice and my conversation, my poetry, you know.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Live pictures from Parliament in the United Kingdom as they just respond to some important headlines coming from the British Prime Minister. UK defence budget to reach 2.5% of GDP by 2027. To kickstart with the Prime Minister going on to say the defence budget will hit 3% of GDP in the next Parliament. How will we fund this, you might ask? UK foreign aid will be cut to fund defence. What does that sound like?
USAID. I mean, this sounds exactly like what happened in the United States, although it's coming to increase spending on something that has been underfunded for years.
He will sit down with the American president later on this week Donald Trump. Look out for that conversation. We're all fixated on the bond market here stateside. Yields continue to drop. We're down by 7 or 8 basis points on a 10-year, 432.32. Under surveillance this morning, the bond rally continues.
What's necessary are the underlying conditions. So the underlying conditions that we need for yields to come down, for growth to go back up. We've got this affordability crisis in housing. We've got an affordability crisis in the auto payments. So one thing that would be very stimulative, the 10 years come down, or rates have come down every week since Donald Trump's been president. So if we can continue that for 52 weeks, that'd be great.
It continues. 10-year bond yields falling for 5 consecutive days, dropping to a 2-month low. Tom Tedesouris of Strategas writing, debt ceiling-driven liquidity will enter the market in large numbers this week. This should temporarily lower longer-term bond yields, mortgage rates, and corporate spreads. Tom joins us now for more. Tom, welcome to the program. Let's talk about the last 6 weeks, not just the last 5 days. What's been driving this move in fixed income?
Yeah, and good morning. Thank you for having me. I think there's really 3 things that have driven this drop in yields. The first one is pretty much played out, and that is the realization that the global trade war is not going to come to fruition. Worst case scenario is not going to play out. Even maybe the semi-worst case scenario is not going to play out either. We're very likely to still have tariffs along the way, but the trade war worst case scenario is no longer on the table. That's pretty much played out, and the bond market has taken that risk off the table. Point number 2 we're starting to see now is really filtering into the bond market, and that is the realization that we're right now in the midst of what I call a seasonal slowdown. Middle of Q1 and late Q3 are our seasonal slowdown periods because of consumer debt hangovers. And we're in the midst of that right now, and there's always a concern that that seasonal slowdown will become a prolonged slowdown. And that's where we are right now, and the market's starting to fear that this is becoming a consumer pullback, especially now without the tailwind of fiscal stimulus at our backs. And point number 3, and the debt ceiling is part of this, and this is also playing out particularly this week, is that there's a realization that the worst case scenario on Treasury supply is temporarily off the table. And what I mean by that is coupon auction increases are not slated for this quarter, next quarter, and probably not even third quarter. That means fourth quarter and later, so the market doesn't have to worry about that right now. On top of that, the debt ceiling has been hit. We're in extraordinary measures. Cash is coming into banks today. That does tend to flatten the Treasury curve temporarily. And then last but not least, there was some commentary from the Fed in the minutes suggesting that there is an appetite to end quantitative tightening somewhat in the near term. That could mean early Q2. It might mean late Q2, but they're not now starting to have a conversation, whereas a month ago it seemed like this was just an indefinite policy, quantitative tightening. So all of these factors have helped to push yields down, but this week particularly, the debt ceiling cash is the big force.
Tom, there's a lot to pick through there. I want to just emphasize one point you said, that this is essentially the bond market saying that the idea of a trade war is off the table. So you disagree with Jordan Rochester's assertion that tariffs are no longer being treated by this market as inflationary and just view it as actually people not taking a lot of these threats that seriously?
Well, I think it's both. I think there was an overreaction late last year, perhaps because it was pushed out through media sources that tariffs were going to be explosively inflationary, exponentially inflationary were some headlines I'd seen, and that was just never going to happen. But now I think there's also a realization that these are going to be, if they do happen, tariffs, they're going to be incremental, they're going to be targeted, and there will be dialogue back and forth. So the risk of a trade war seems less likely as well. So it's both. It's not just that there's going to be less chance that it's an explosively inflationary environment, but there's also a chance, more likely, that this is just not going to play out to the worst case scenario.
Hey, Tom, appreciate it. Tom Tedesouris there at Strategas. 6 weeks of falling 10-year bond yield stateside, and it's quickly becoming week 7. The 10-year down by 8 basis points this morning.
And a real question about the consumer confidence data that we get later this morning, 10 a.m. Eastern. Does it confirm what we got out of the University of Michigan Sentiment Survey? Mike Wilson of Morgan Stanley is saying it's really important to look at this one because of its labor sentiment aspect as opposed to simply just spending.
That data point taking on additional importance after the numbers we saw on Friday. And not just the numbers Friday, retail sales have been softer. Walmart spooked people a little bit as well, so look out for that later on this morning. Coming up next in the next hour of Bloomberg Surveillance, we'll catch up with Tom Kennedy of JP Morgan, Bloomberg's Mark Gurman, and Neil Dutta of Renmark. Plus later, David Rubenstein sitting down with the Bank of America CEO, Brian Moynihan. We'll take that live and in full right here on Bloomberg TV.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And, in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like this, the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. In the meantime, some people who care about this issue are really out, trying to think, do we need permitting reform? Do we find, what new ideas haven't we found yet? How do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
In case you missed it, on Bloomberg Open Interest.
11 years ago, I bought a Bitcoin on this set.
It was $800.
Yeah, $800, but I spent the Bitcoin on beer and groceries and gas and video games.
And
I wish I had kept it. I wish I would buy a Harley today if I had.
Yeah, but you probably wouldn't be a TV anchor, and you probably wouldn't still be on this
True.
set. And what a joy that is.
I'd be my feet in the sand and the beer in my hand.
Don't miss the next Open Interest.
The market is very quick to react and change narratives that we're in a Goldilocks scenario and then very quickly say, oh, no, this is recessionary.
With the broadening of the rally that we've seen, we've also seen a broadening in terms of earnings growth.
In terms of kind of the earnings story of the United States relative to the rest of the world, it has been driven by big tech.
It's really the tech sector that is very vulnerable, not because they're not making money, it's just that their valuations are too high.
Ultimately, it'll be a good environment for stocks, but it's going to be a little bit more difficult.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the opening bow stateside. Equity futures on the S&P 500 just about unchanged to positive by almost 0.1% on the S&P 500 following a 3-day slide. On the Nasdaq 100 shaping up as follows, totally unchanged as well. This is child's play. The interesting stories in the bond market. 2-year, 10-year, 30-year, driving lower across the board. 6 consecutive weeks of lower yields in America, a run we haven't seen in more than 5 years. The 10-year this morning down by 7 basis points, 432.51, and driving lower once again.
The tail risk is no longer, at least at the moment, the prospect of inflation reaccelerating. And that has totally shifted the narrative where suddenly, as Michael McKee pointed out, you have 2 rate cuts now being priced into the U.S. market coming through the end of this year by the Federal Reserve. Does this change the narrative once again? Or maybe people are looking for some sort of growth shock to the upside. Maybe there'll be a little bit of a hit on the margins. But the Fed may be coming a little bit more into play after being sidelined for a bit.
The next stop for this conversation, 10 a.m. Eastern Time, 2 hours away, when we get another read on consumer confidence. Consumer confidence a bit softer than expected in Friday's read over at Mitch, and inflation expectations a whole lot higher.
Inflation expectations a whole lot higher. One caveat, Jonathan, you mentioned earlier in the program, which is why this 10 a.m. data point is very important, is the political bias that goes into the University of Michigan. Democrats are not feeling very excited about inflation prospects or what is going on. They're concerned about tariffs. Potentially we get a little bit more of a clearer read at 10 a.m., especially at a time when this market and market participants, the angst is about trade. Because Donald Trump said last night, their tariffs are going forward, they're on time, and they're on schedule.
It's Tuesday. Let's talk about feelings and consumer feelings. And sometimes when they say that they're not feeling so happy, especially on a survey that they answer online, and evidently they're more unhappy online than they are over the phone, it doesn't translate into less spending. And we have seen that consistently. Now we get prognostications from CEOs about the uncertainty going forward at very low benchmarks that they can easily cross later this year should that change. How do you put this into a picture where you can point to one indicator showing real strong growth and another showing real deceleration?
You buy bonds, apparently, and that's what's been happening for the last month and a half. Yields lower across the board once again. Equity futures just about positive by 0.1%. Coming up this hour, we'll catch up with Tom Kennedy of JP Morgan, with stocks looking to snap a 3-day losing streak. Bloomberg's Mark Gurman looking ahead to Apple's shareholder meeting, and Neil Dutta of Renmac on why he's not constructive on the U.S. economy. Neil joins us in about 30 minutes from now. We begin this hour with stocks lower as traders weigh fresh tariff concerns. Tom Kennedy of JP Morgan writing, our base case remains that additional tariffs will be levied on China and other countries. For national security concerns, the risk of broad-based tariffs remains, but we think it's a low likelihood. Tom joins us now for more. Tom, good morning.
Good morning.
What instructs that view? What guides it?
I think it's just the assessment of how things have changed over the last 10 years in the global supply chain paradigm. China has been supplying the world's critical industries and oversupplying them for a long period of time, making the rest of the world reliant on them for critical minerals, batteries, and processed minerals that go into all electrical products that we go through. So when you look at the tariff, it becomes a critical way to slow down that integration into supply chains from China, but you will eventually need subsidies to rebuild, and that's a common thread between the Biden administration and the Trump administration so far.
It's not just tariffs on China, also a levy potentially of 25% on Canada and Mexican imports as well. The president yesterday was pretty clear. Tariffs are going forward on time, on schedule. Do you buy that?
It's not our base case right now that happens.
It's a week away.
It's true, but the last go-round, we went to the last hour too, so it is possible to keep that going. And when you look at just the trade dynamics between Mexico and Canada, this is well discussed that we are, America, are the biggest importer. We rely on them critically for their inputs, but as a percentage of GDP, those exports from Mexico and Canada are a big piece of their GDP. So there is a lever that America can pull to get what they want. The question is, if we are negotiating, what are we really negotiating for? That still remains pretty unclear to us. So that's what we'll be looking for in the next week or so. Are we negotiating? And if so, what are we negotiating on?
The past 5 weeks have been a really exhausting exercise in deciphering signal from noise. I think for a lot of people, and it sounds like what you're saying is that tariffs right now, barring a couple of them, are more noise than signal when it comes to what's going to come into effect. So what's the signal? Where are you getting that?
Well, just let's hit the noise for a second. When you look at 2018 and 2019, the market's reaction to tariff announcements, the S&P 500 was moving 2.5% on those announcements. Now you're talking about tariffs that are substantially bigger, and the market's moving 50 basis points, 30 basis points. So I think the market is doing a better job this go-around in this Trump administration than in the first one of finding that noise and saying, I'm not so worried about that. But when you look for really what is the signal, what is the big picture here that we're trying to solve? Is the big picture trying to solve migration trends from Mexico or from Canada? Maybe. Is it fentanyl? Could be. But the bigger issue of national security isn't really relying on Mexico and Canada. It has to do with, I think, this reliance on China. And just to sit in front of any person, any client, and say 80 to 90% of NVIDIA's chips are made in Taiwan, that could say the dominant reliance we have on one specific product becomes a national security issue. It has nothing to do with one company, just of that type of reliance becomes an issue in of itself. And then you can start to look at processed minerals from China. 90% of the world's processed minerals for electrical motion come from China.
So what's the market signal there? Because these two economies are deeply intertwined.
Yeah.
There is something that we've been talking about. John brought this up earlier. You know, a lot of people agree that this should be done, but there will be some pain as a result of it. Do you see pain that's not being priced into the market as a result of some of these trade practices and some of the goals that will go into effect?
I think I just see the market playing the downside of what will actually be implemented. The tariffs is one case, and when you start to look at some of the other policies, whether they be immigration, deregulation, the market is now just muting what they think will actually come through. On the deregulation side and capital markets activity, we're 2 months into the year now, and things really aren't picking up. They're not picking up in the way that we thought they would. I think you still need to give it another month or so to see if it's really true, but these high expectations that we had for the impact, I think the market is now saying, it's quite unlikely we'll get that full impact.
What I hear from you is it sounds like Trump 2.0, the market has almost become numb to everything he's talking about, especially in the trade world. Is that accurate, though? Because Mike Wilson was on saying that maybe this time is different. Trump isn't coming out truthing every time there's a new stock market high. Maybe he's not regulated as much by where the Dow Jones is.
I think this time is certainly different, right? He came out of his inauguration day with pronouncements, executive orders that we hadn't seen in the past. That is different. But I think what's similar is the fact that we had high expectations for big market and economy impacts, and it's hard to get all of those things done as fast as we all thought that they could be done. So we're seeing a slower on-ramp for that.
One part of your thesis is accurate, the base case that additional tariffs will be levied on China, in the sense that those are the only tariffs this administration has actually levied on.
The only thing that's stuck so far.
10%. How high do you think it goes?
Our baseline is that you'll see tariffs go up another 10 or 20% on China. If you actually want to do this separation, it has to be meaningful and it has to be impactful. But again, if it's national security, if that is the end game, and to be clear, we do not know what the end game is. We're trying to figure that out.
He says reciprocity.
Well, reciprocity becomes more impactful for the economy. I mean, I teach my children the world is not fair, but if you look at trade right now, it is very unfair. Most of the goods that America exports is tariffed more than what we tariff for things we import.
Yeah.
But if you do that, what you end up having is a price shock higher, which will likely mean growth down. That's the stagflationary end game that would be quite negative for the market.
Let's go with your additional tariffs on China. What would you avoid? What would you go into based on that call?
I think I think in that AI trade, it favors software over hardware. That transition is happening, and after the DeepSeek announcement has already happened. But if those tariffs get levied some more, there are individual names you can pick out, and I think you guys do that well on the show already. But then also it does favor the bond call. I mean, you're moving into a world where higher tariffs, if that is the only thing, does have this unlikely effect of higher prices and lower growth. And the Fed, what we learned from them is they tend to favor the lower growth outcome. And I think that's a piece of what's happening in the bond market in the last couple of weeks.
That's what the front end might speak to. What does the long end speak to?
I think the long end is speaking to you that this big worry about the deficit exploding is not as big. The supply concerns are not as big. But I think it's really just simply economics.
Yeah.
In that U.S. Growth outlook is a little bit muted to the downside, and that's the dominant driver of the 10-year. And when you start to play with some of your models, they're very similar on Wall Street. Take a Taylor rule model in the front end, it says you should cut 1 or 2 times this year. That's kind of where the market's pricing. And at the moment, your premium in the long end is actually still very small compared to what we've seen over the last couple of years.
Mike Wilson of Morgan Stanley was on earlier, and he was saying it's a trader's market in the stock market. Is it a trader's market at the long end of the yield curve, or is it a buyer's market?
I think it's going to be a trader's market for a while. And it should be in this, when we're in this phase of the Fed giving you no guidance, and we're actually going to see individual prints driving the market. And you can simply just look at the MOVE index where you're seeing still relatively elevated interest rate volatility. That's a trader's market until we get firm signal of which way we're going. Towards the back half of the year, if our baseline is right, the Fed will be back in market cutting, not aggressively, but still a few more cuts that would be necessary just to firmly rebalance the economy.
Bond yields down across the curve this morning. Thomas, good to see you. As always, Thomas Kennedy there of JP Morgan Private Bank. We're down by 5 basis points at the front end of the curve, 411. On 10s, new lows for the year. We're down 7 or 8 basis points to 432. With an update on stories elsewhere this morning, with your Bloomberg brief, is Danny Berger. Hey, Danny.
Hey, John. UK Prime Minister Keir Starmer affirmed his country's commitment to increasing defense spending. Speaking about 20 minutes ago, Starmer said the UK will increase its defense spending to 2.5% of GDP by 2027 and will aim to increase that to 3% in the next parliament, should conditions allow. Starmer going on to say that the hikes in defense spending will be paid by cutting foreign aid, not by taxes or borrowing. Bloomberg News has learned that Elon Musk's SpaceX is seeking to deploy Starlink satellite internet terminals to help upgrade the Federal Aviation Administration's national airspace system. The effort raises questions about conflicts of interest for Musk's business empire and the future of a $2 billion contract that was awarded to Verizon in 2023. Former New York Governor Andrew Cuomo is reportedly on the verge of running for mayor of New York City. The New York Times is reporting that Cuomo may announce his candidacy as soon as this weekend. He resigned from office in 2021 over sexual misconduct claims. Cuomo denied the allegations. And that's your brief, John.
Danny, thank you. More from Danny a little bit later. Up next on the program, the Morning Calls Plus. Bloomberg's Mark Gurman with a preview of Apple's shareholder meeting. That conversation up next. Equity futures just about positive by 1/10 of 1%.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
open in about 1 hour and 15 minutes away. Equity futures just about positive. In the bond market, this decline in bond yields continues. Yields are lower by 6 or 7 basis points. The 10-year 4.33. We'll come back to that in about 15 minutes' time. Let's get you some morning calls. First up, Barclays lowering its price target on Toll Brothers to 101, citing the company's cautious tone around demand. That stock is up by 1.3%. Your second call from Argus, downgrading Domino's Pizza to hold, noting higher food prices and labour costs. That's one to watch. Stock is down by 0.4%. And finally, Citi raising its price target on Hims and Hers, citing multiple avenues for growth following the company's earnings. That stock getting hit for very different reasons this morning. We're down by about 21% in the pre-market. Let's turn to Apple. The company holding a shareholder meeting later on today. Investors set to vote on a motion that would force the tech giant to scrap its DEI policies. Bloomberg's Mark Gurman joins us now for more. Mark, welcome to the program, sir. Got to build on your story from yesterday morning, which got a ton of attention. The statement from Tim Cook on increased investment into the United States, increased hiring into the United States. Was that a message to shareholders or a message for the White House?
I think it was a message for one man, and that would be President Donald Trump. It's pretty clear that Apple wants to avoid tariffs, particularly on the iPhone, right? That 10% additional tariff on goods imported from China would be not destructive, but would be, I guess, hurtful to Apple's bottom line, specifically the margins on the phone. They definitely don't want to have to deal with that. And so what they've done here is they've essentially taken investments that they had already announced years ago or planned to implement, talking about 5,000 R&D hires a year, investments of $125 billion in U.S. interests every year, and they announced it and put it in a pretty package for Donald Trump to see it. Now Trump is able to go back to his supporters, go back to Congress, go back to the citizens of the United States and say, I got Apple to invest $500 billion into the U.S. Now, that's not true. They were essentially doing that anyways, but Trump gets to claim that. And in exchange, Tim Cook probably will end up getting a reprieve at some point on tariffs to some extent.
Well, adjusted for inflation, $430 billion in 2021 is basically the $500 billion today. So the commitment he gave to Joe Biden, he's giving to President Donald Trump yesterday. But the key is he wants this flashy proposal because of potentially a carve-out. What could that carve-out be when it comes to tariffs?
Well, we just look at what happened last time, right? In the first Trump administration, Apple didn't get an additional tariff on the iPhone in the end, right? Tim Cook made these same maneuvers, 7, 8 years ago at the beginning of the previous Trump administration, and the iPhone didn't end up getting slapped with tariffs. You saw some tariffs on some other lower priced Apple products, AirPods, some of the Macs, some Apple Watches, some keyboard accessories, cables, chargers, etc., computer components, but that really would not have as significant of an impact as tariffs for Apple on the iPhone. Back then, Tim Cook, and I'm sure he made the same argument again, said that Samsung would stand to benefit, right? Apple, they make all their stuff in China, but they are still an American company based in California, right? Samsung, they make their stuff overseas. They import a lot of it into the US, but they don't make their stuff in China. So they wouldn't be subject to tariffs to the same extent as Apple. And by the way, they're not a US-based company. They're a South Korea-based company. So that was, I think, a pretty good argument on Tim Cook's point. The same argument he made again, right? But now you combine it with these press releases showcasing that Apple is making changes and believing the United States, timing it, right? I mean, I think it was very clear that the prior announcement, that came in 2021 when Biden had a few years left in his administration. But Donald Trump started his second term about a month and change ago, right? He was inaugurated mid-January. We're in mid-February. And Apple's announcement was very clear to say over the next 4 years, right? So this is very much phrased in a way for Trump to be able to present it as something specific and special to his term.
What I find fascinating about this, Mark, is that Tim Cook's response to the threat of tariffs is to kiss the ring. It's not necessarily to shift production more rapidly out of China or shift a greater proportion of business away from China. Is that basically the core of it?
Well, it's not possible to shift the majority of production outside of China. Don't forget, Apple spent 25, 30 years building up its supply chain in China, and you can't just rebuild that even over 10 years in another part of the world. There are so many idiosyncrasies, so many specific things in China that make it palpable for Apple to produce there that really can't be replicated in other parts of the world to the same scale that it is in China today. They're doing some iPhone production now in India. They have some production going on in places like Brazil. You're seeing AirPods and Apple Watches and Macs being produced in Thailand, Vietnam, Malaysia, right? You're going to see some production be done in Indonesia. But for 95% of their products, they're still being produced in China because Apple does not have an alternative to be able to produce at the same costs, fit and finish, and scale as they're able to do with Foxconn in China and across the region right now.
Mark, it's really important to address this and just build on it a little bit more. 20 years ago, even 10 years ago, we would have all sat here and said it's about cheap labor. And Tim Cook's made the argument that it's not about cheap labor at all. It's about advanced labor, being able to find people with a skill set to do this job. How important is that with regards to China at the moment?
I think it's one component, right? I mean, you're going to get labor at similar costs to China, right? In Vietnam, Malaysia, Thailand, Indonesia, Brazil to some extent. But what you're not going to get is the sheer scale, number of people, and sizes of these factories, who, by the way, have been doing this stuff for 20 years, so they have the experience, right? Apple is not going to risk quality, right, in order to move its supply chain. The quality of their products and their hardware is what allows them to price their products and have these immense margins. So it's not about how much they're paying these people. It's about how many people they're able to get. It's how many people they're able to get within the manufacturing culture in China. It's how many people they're able to get with the experience they need, and it's the equipment and machinery and different machinations of how this is all done that they've really set up for the past 2-3 decades. So it's going to take time to move everything. Even if Apple started relocating its supply chain right when Donald Trump took office in 2017 the first time, we're in 2025. They wouldn't be anywhere near the finish line at this point. This is a multi-decade effort, and I quite frankly don't think it's ever going to happen. We've been talking about this diversification for years, and that's all it is. It's diversification. It's not relocation.
Tim Cook, the ultimate diplomat, is in a really precarious spot. And as I hear you talk, I just think more and more. On one hand, Apple is creating partnerships with the likes of Alibaba to try to advance some sort of artificial intelligence in China, at the same time that they're trying to placate Donald Trump and his desire to bring business and to bring jobs back to the United States. Is there a sense that he will not be forced to choose? And if he is, that could be catastrophic for the business?
Well, let's talk about Alibaba for a second and China. That's placating also. Apple knows that it's not going to be able to sell as many iPhones as it would like to in China if it doesn't have AI. Now, I'm not going to sit here and argue that Apple's AI is good or bad. Okay, fine, I'll tell you, it's not so great compared to the competition. But from a marketing standpoint and from we have that feature too standpoint, it's essential to have in places like China especially. So Alibaba, that partnership is also placating because they can't sell iPhones with artificial intelligence in China by law unless it has what I call a censorship engine, right? A place or a feature within the iPhone where if China, the government there, the technology-based regulators there disagree with an AI-related output from the iPhone, right? They need a middleman there to be able to fix that, to block, to censor, right? To modify content. And so the Alibaba partnership is essentially a layer on top of Apple's on-device large language models on the iPhone, right? That can shift the models, change the models, and update the content on the iPhone at the behest of the Chinese government. So you are seeing Apple placating in other areas of the business. And Apple always talks about how it follows the rules and regulations of the countries it operates in. And Tim Cook's ethos from the beginning has been to make adjustments to a certain extent, and in many cases, a dramatic extent, in order to keep selling their products in the region. Apple doesn't want to cut back on margins. Apple doesn't want to lose any revenue over a disagreement with the government. So they're going to do whatever they can in any country to keep things moving. Another example last week was in the UK. They pulled a feature called Advanced Protection, right? This is a feature that enables end-to-end data encryption for your files stored in the cloud through Apple on iCloud, things like messages, things like notes, reminders, right? So that is being pulled, right? Advanced data protection from China, or from the UK. It actually is in China, but it's pulled from the UK because the UK asked Apple to build a backdoor into its devices globally so the UK government can infiltrate the data of anyone it would like to. And instead of building that back, or they basically
controversial over the last few weeks on that front. Mark, we've got to leave it there, sir. Thanks for joining us. Mark Gurman there of Bloomberg on Apple. The story of Apple, just to hear Mark talk about that with regards to China and production. We're in China for quality. In China for quality. Not because of cost. Cost, of course, is a part of that, but in China for quality. That's a new part of the China story over the past few years.
And they've pushed to have more skilled labor. It's also the point about why all of NVIDIA's chips are produced in Taiwan. It's not because of being cheaper. It's the quality and the sort of supply chain of talent.
Up next on the program, we'll catch up with Neil Dutta of Renmac on why he sees a slowdown in the labor market and the broader economy. That conversation is up next.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Equity futures positive here by a little more than 0.1%, following a three-day slide on the S&P 500. We have a bounce, just a small one, up by a little more than 0.1% on the Nasdaq 100 with 60 minutes until the opening bell. With your morning movers, here's Yahara Hackos. Hey, Yahara.
Hi, John. We start with Eli Lilly shares. Those are getting a bit of a boost here in the pre-market, up 1.5% on the news that it plans to cut prices on some of its obesity drugs. And this is a way for the company to stave off competition from the cheaper alternatives out there because, as I said before earlier, the FDA is trying to clamp down on this, but they can't get everyone. So Lilly says you can expect to pay about $50 less for its Zepbound vials. Next up, we have Chegg, the company that helps you study getting clobbered here in the pre-market, down nearly 22% as it faces increasingly tough headwinds due to generative AI because, as Lisa knows, all the kids use ChatGPT these days to study, and it's gotten so bad that Chegg is now weighing strategic alternatives to its business. And I wanted to end with something sweet, but there is nothing sweet about Krispy Kreme shares right now, down about 15% in the pre-market. Fourth quarter revenue came in weaker than expected because of a hacking incident that happened last year, plus the sale of its majority stake in Insomnia Cookies. That was a more than $100 million hit to revenue, but the outlook doesn't look good either, and that's also what's weighing on the stock here. John?
Yara, thank you. Just seeing you get very excited about Insomnia Cookies.
Yeah, it's my guilty pleasure because they have a gluten-free vegan cookie.
Okay.
They're
That it's healthy.
delicious.
That it's super healthy.
Super healthy.
I'm not saying it's healthy. I said it was my guilty pleasure.
All I can say is those two things put together. You do generative AI, do your homework, and you sit there and eat Insomnia Cookies. That's
Gluten-free, dairy-free.
Yeah, it's the way to...
Vegan cookies, they're so healthy. Let's turn to the economy. Neil Dutta of Renmac raising concerns on the labour market, writing much of what we see in the financial press, tariffs, uncertainty, is a red herring. An ex-post rationalisation for an economic slowdown that was already in motion. For the economy, expect conditions to deteriorate further in the jobs market. Neil joins us now for more. Neil, welcome to the programme, sir. As soon as you hit publish yesterday, we talked about that note. Fantastic read. Neil, just share with us why you think this is a train already in motion. It's not about the last month.
Well, John, I'm beginning to have second thoughts already because I see Anne-Marie rocking Fendi on the program, so it must be a bull market, no?
Vintage.
Someone's spending, Neil. She says it's secondhand. I don't know if it is.
Sure. No, all I'm doing, John, is just applying the playbook from late 2022 when we made that no landing call. Remember, if you recall, it was basically four things: real incomes, housing, government spending, and just the way the consensus was positioned, right? So you fast forward to today, real incomes are slowing as the labor market continues to cool. The housing market is getting worse. Even though the Fed had been cutting, state and local governments are pulling back. The Doge gets all the attention, but really state and local government spending has been a meaningful tailwind to growth, and that's likely to go the other way. And if you look at the consensus, I mean, back in late 2022, everyone was positioned for, essentially recession. I mean, people held onto that view, believe it or not, through the middle of 2023. So one of the ways, it works is through an element of surprise, right? I mean, if everyone expects recession and it doesn't happen, you have to have this sort of period of catch up. By contrast, if everyone is expecting things to be fine and then they're not, that could, prompt a clearing out of inventories, hiring, investment, and so forth, and kind of create a negative feedback loop with the economy. So that's kind of what I'm concerned about. The data hasn't been particularly encouraging of late, and I'd expect that to continue until the Fed gets on the right side of the 8 ball.
Well, Neil, let's talk about the Fed. We all said yesterday, what's worse than a slowdown? And it's a slowdown the Fed's not willing to respond to anytime soon. Now, the Federal Reserve was willing to get ahead of something last year. They dropped rates by 100 basis points across 3 meetings. What changed coming into 25?
Well, I mean, they're basically taking out an insurance policy against the new administration. That's basically what happened. I mean, if you look at the adjustments to their risk assessment around inflation, the notion that they're simply innocently responding to the inflation data, I think, is a bit ridiculous. The upside surprises on inflation that we saw in the back half of last year paled in comparison to the upside surprises we saw in the first half of last year. And, the risk assessment didn't change all that much. So, to me, this kind of feels eerily similar to the period between June 2024 and September 2024. We went, you know, if you recall, I mean, the Fed basically went peak hawkish in June, and then 3 months later, they're cutting 50 basis points. So I think where I'm at right now is the Fed is waiting for permission from the markets and the data in order to respond. And that's essentially tempting fate. I mean, if you're waiting for something bad to happen before you move, chances are something bad will happen. I mean, what changes the trends that we're seeing at the moment?
Well,
absent some kind of Fed response.
Well, but Neil, I think that a lot of people are picking up on the same thing that you are, and suddenly the idea of tariffs is no longer considered so inflationary, and it's considered more of a growth shock in the absence of some other pro-growth measures. Right now, it seems like the bond market is turning around to your side. Now we've got 2 rate cuts being priced into the market through year end. Is that enough to make you more positive if the Fed does go through with a 50 basis points of rate cuts by the end of this year?
No, not really. I mean, I think the Fed will need to do more than what's priced because the economy is weaker than they think. It's really that simple. You know, I do find it kind of amusing how everyone is basically using tariffs and policy uncertainty as a rationale for their forecast adjustments now. I mean, to me, it's a bit rich. You know, as if you know, if you thought that, I mean, why didn't you make your changes back in November after the election? It's not, I mean, the guy ran on tariff being his favorite word in the dictionary, and now you're surprised that he wants to go through with it? I mean, it's crazy.
But hold on a second, Neil. But let's just be clear. It's not just that he's going through with tariffs. It's, as John has mentioned many times, the sequencing of it, that there isn't a clear path for some of the offsets with respect to the tax cuts and the pro-growth measures, and you're not seeing the boom in deal activity. That's the reason why people are focusing more on the growth hit from tariffs than they are inflation, no?
No, I mean, I think what I'm seeing more is people talking about policy uncertainty related to the Trump administration, and that's why they've gotten cautious all of a sudden and why there will be a freeze in sort of investment and so forth. I mean, to me, it's ultimately demand that's going to be driving the discussion, and household demand is slowing because the labor markets continue to cool. You know, the tariff stuff, I mean, again, this is all just sort of ex post thinking. I mean, uncertainty would be high if the shoe were on the other foot, right? Because we'd have one of the largest tax increases ever, potentially, at the end of the year. You don't think businesses would be worried about that? So it's just sort of like this heads I win, tails you lose type of analysis that I think is a bit ridiculous. I think everyone should just focus on the here and now, including the Fed. You know, instead of trying to take out an insurance policy about what may happen or may not happen, I mean, Congress is very evenly divided. I mean, the sort of fiscal expectations that people had baked in after the election, you know, you could pin that at the feet of Congress, right? I mean, so it's not just the Trump administration from where the uncertainty is coming from, but I think it's wise to just focus on the here and now. And what the here and now tells me is that demand is slowing down, housing is still weak, and inflation is likely to continue to moderate as rental inflation keeps cooling off.
He knows his Fendi, and he nailed it at the end there. Neil Dunter of Renmac. Neil, got to catch up. Longer conversation when you're back in a studio next time here in New York. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Elon Musk said federal workers will be given a second chance to respond to an email detailing what they did last week or face termination. The federal agency that sent the email on Monday said it's up to the agency leadership, not Musk, on what happens to those who ignore the message. President Donald Trump defended Musk's efforts, saying that it is a legitimate bid to root out fraud and waste in the government. Elsewhere, AI startup Anthropic is said to be nearing a deal to raise $3.5 billion. People familiar with the matter say that the funding round would value the company at almost $62 billion, which is more than originally planned. The Philadelphia Eagles appear to be White House bound after all. Earlier reports suggested that the Eagles had turned down an invitation from the White House to attend a ceremony to honor their win. A source says with the team confirmed that they would be honored to visit, though the White House has not yet sent a formal invite. The Eagles did not visit President Trump's White House when they won their first Super Bowl in 2018. And that's your brief, John.
Danny, thank you. Appreciate the update. Thank you very much. Now I want to take you over to the Economic Club of Washington, where I'm pleased to say that David Rubenstein, the Carlyle co-founder and host of peer-to-peer conversations on Bloomberg TV, is joined by a good friend of this program, the Bank of America CEO, Brian Moynihan. Let's take a listen.
There's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. and we have to close accounts, and we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right. And I think it opens a dialogue about how to get these regulations correct. In the end of the day, we're open for everybody. We serve millions and millions of Americans, trillions of transactions a year, and we'll continue to do so.
Okay, so when this administration was elected, there was a lot of, I would say, jubilation in the streets of the banking world. People thought that the banking regulation had been too tough under President Biden. Some people thought that regulation would be more amenable to banks. Has that turned out to be the case yet, or is it still too early to know? And is the banking community happy with the direction that the current administration is going, or you just don't know yet?
Well, so you have to sort of step back and say, the regulation of banking has always been true since our charter, our oldest part of a bank was from 1784. So we've been regulated from that day forward. If you think about the great financial crisis and Dodd-Frank and a lot of capital rules and liquidity rules and all that stuff came in, there was a reason for the world writ large to be really not happy with banks. And non-banks that became banks, Goldman Sachs, Morgan Stanley, Merrill, et cetera. So you could understand that. When you go fast forward through the 15 years hence, plus you go through the pandemic and the banking system stands up and stabilizes the economy. You go through the regional banking crisis, the banking system steps up and stabilizes it, and they keep adding capital and liquidity. You're sort of saying, wait a second. We are a source of strength. And by the way, the American banking industry is really a source of strength. So the pendulum kept just swinging, even though the reason why it had swung had stopped. And so our industry was saying, wait a second, why are we have 20% more capital than we did during the pandemic? The risk is the same. It's just by mathematical creep of calculations. Why are you saying we're going to limit your fees charged for a certain activity or deem an activity a loan when it wasn't a loan? And with hundreds of years of history saying an overdraft is not a loan, somebody just says, I want to make it a loan. And so this idea of the regulators sort of imposing new rules and regulations that Congress did not intend, actually, was kind of an interesting question.
Right. So many people, when they talk about the Federal Reserve, they wonder whether the Fed's going to increase interest rates or decrease interest rates. But in the banking community, you're often worried about the stress tests. Right. And do you think the Fed has pushed stress tests to too tough a limit on banks, or are you okay with the current stress tests?
So the stress tests are publicly available. I think the first one was 2010 and then picked up in earnest 11 or 12. And so every year you can see this report card on the banking industry's health. And every year the banking industry has great health. But the issue we got in the banking industry ended up suing the Fed was behind the scenes the rules kept changing in the test. So if you think of the last 4 or 5 years, you had volatility in capital requirements that were, went from 50, 75 basis points up and down a year with basically a test that said 10% unemployment, 50% downturn in the equity markets, 30% drop in housing, 30 or 40% drop in commercial real estate, high yield spreads blown out by 1,000, 2,000 basis points, whatever it was. You look at all the same test produces different results. It didn't make sense. So behind the scenes, the transparency wasn't there, and that's what we ended up suing them on. So the stress tests are a very good thing. Frankly, it gives us state of health for 31 banks, which cover most of the industry. The way the United States run them is far superior. We do stress tests every quarter, multiple scenarios, and our trading book is stressed every day. So if you think about it, it's a good thing. It's just that behind the scenes, what was happening is the dials were being turned on us, and the numbers were becoming irrational to the market. And we have investors, and we have to raise capital and have capital available for the industry.
So there's a vice chairman of the Federal Reserve who's in charge of regulating the banks and so forth. That person has given up that position recently. And was that something the banking community was happy with, that he stepped aside, or you didn't really care whether he stepped aside or not?
Well, at the end of the day, I think he had a year left on his term, and the new administration president would appoint someone for that position. Look, at the end of the day, as when people always ask me, do you have different approaches for different administrations? And you say, well, in the long term, we've been around since Washington was president. So if we geared ourselves up for this president, not that president, we'd have to change 45 times, whatever it is. And if you think even of in the foreign soil, think how many different prime ministers there's been in England, or so even in my tenure as CEO. So at the end of the day, you run the company the right way. And what we're trying to say is get us to a rational regulatory structure that and have it stick to the ribs. If you keep swinging like this, our clients can't depend on us when they need us.
So before the Great Recession, there were a number of large banks in the United States and Europe and Asia. And now it seems as if post the Great Recession and post-COVID, the United States is dominating the global banking world. What happened to the European banks? They're not really competing with you and JP Morgan and Wells Fargo as much as they used to. What happened? What are the American banks doing that enabled them to become so dominant in the banking world?
The American banking system is probably a story as much of American capitalism being successful, because in the days, the banks in the country represent the size, scale, and scope and the vibrancy of that economy. So what happened from pre-financial crisis to now is at that time, you and I have been sitting here talking about how China's economy was going to be bigger than the United States by now. The European economy was as big and was going to outgrow the United States under the enthusiasm for the EU framework. And guess what? We're 1.5 times the size of the economy back then. Europe's like 1.1 or whatever it is. So we've outgrown them. That's part of the vibrancy in, frankly, dealing with the financial crisis, recapitalizing industries, failing a bunch of industry participants, bringing people into the tent, the right regulations, and then going forward. And so what's happened is Europe is not kind of crawled out economically. Therefore, their banking system has been hamstrung at the same time.
Now, you've been the CEO for 15 years, and the bank has recovered from a lot of problems it had when you took over. You've got a great career. Suppose the President of the United States said next year, I need a new chairman of the Federal Reserve Board, and you've been running Bank of America. Why don't you come in and be chairman of the Federal Reserve Board? Your response would be?
I think I'd say talk to David Rubenstein.
No, I don't think so. No, I'm sorry. So
our company, look, in the end of the day, I get up every morning and I've got teammates out here in the audience, and this team is unbelievable. And if you see what we do for a customer, and my emails in the public domain, and customers send me when we're doing great things for them, and when we're not doing great things for them, come directly to me. Nobody reads them but me. And so if you see what we can do for a company, for individual, you see the enthusiasm for a young kid who's opened an account, enthusiasm for the 4,000 or 5,000 kids we hire between 18 and 22 that come into our company every year, the communities that we support, that just is a great job, and I love doing it as long as I'm healthy, as long as I have the energy, and as long as the team and the board support me, I'm good.
So recently, another banker you probably heard of, Jamie Dimon, and he testified on Capitol Hill that maybe the regulators and Congress should get together and say, let's just start afresh and take a look at all the banking regulations from a fresh perspective, building from scratch. Do you have a comment on that? Is that a good idea? Or?
Well, I think the spaghetti chart of overlap is the question. So just take the Consumer Bureau. In 2010, with Dodd-Frank, 10 or 11, they set up the Consumer Bureau. The theory was that all the consumer regulatory activity would move to a new agency. Guess what? We still have the OCC regulates consumer activity, we still have the Fed regulates consumer activity, we still have the FTC will hit consumer activity on occasion, and you have the Consumer Bureau, and if you have the FDIC as a regulator, you have the FDIC. So none of that happens, so you end up with another added regulator. Much like after 9/11, HHS came in and it was supposed to swoop everything in, and it didn't quite happen that way. So I think you could start with a fresh sheet of paper, recognizing that in the National Banking Act in the 1800s, or whether the Federal Reserve Act or the FDIC Act in the 30s, the world has changed a lot since then. And so, the idea of national regulatory consolidation, even on a dynamic country like the United States, is probably more appropriate today than it was when you had 10, 15,000 banks all distributed all over. And Tom Barkin's coming from the Richmond Fed. Tom is terrific. But there was a day when everything went on in Richmond, and the Richmond Fed catchment basin was only there. That day is way past.
You're regulated by the Federal Reserve, the FDIC, the Comptroller of the Currency, and anybody else?
The Consumer Bureau, the SEC, the CFTC, then put it this way, there's 100+ regulators in our building every day.
So do you spend a lot of time with the regulators, or you try to avoid that?
I'd like to spend time when they're telling us we're doing good stuff. But no, we all spend a lot of time, and I have a great chief risk officer, and Jeff Greener, who organizes that for the company. All my senior executives spend time with them. And look, the day-to-day regulators are trying to help us be better, and we understand that. We are on the road to perfection as a company. And as Vince Lombardi said, you strive for perfection, excellence we found. That's what we're trying to do. If they've got ideas, we're all ears. Simplifying the organization will allow, frankly, cost to be taken out from the regulatory side, and we pay fees to support it. And it wouldn't be the worst idea.
Now, when interest rates go up, the theory is that banks can charge more for loans, and therefore they're more profitable. And banks have been very profitable in recent years. When interest rates go down, is that a concern to banks because you have less profitability, or you really don't care?
Well, the toughest time to be a bank with $1 trillion, $2 trillion deposits is when interest rates are zero, because we can't charge people to store their money. We're not like a self-storage unit or something like that. So at the end of the day, you have a floor on interest rates. And so when interest rates came down, you started squeezing margins. So the loan rates came down, but the deposit rates have a zero floor. When rates move up, that changes. And so the zero interest checking accounts, all that stuff become worth more, and the loan rates go up. So as long as the rate structure is more normal, and anybody that under the age of 40 has never seen a real rate structure except for like right now. And probably even a little older than that now. And so the idea of a 3% Fed fund rate isn't high rates, it's the usual rate, in fact, on the lower side. A 4.5% 10-year, the usual rate. And so in that environment, banks will make money. But at the end of the day, the net interest margin, which is the difference between what we lend at and what we pay for funds, tends to run 250 basis points. And that benefit goes back to the depositor side and to the debt holder side, and as rates go up and then ups and downs, it's just when it hits that floor, that margin got down to 150 or something like that.
As interest rates come down, though, it's not going to affect your profitability?
Not a lot, because you have...
right? So you don't want Jay Powell's job, it sounds like, but suppose he called you and said, should I increase interest rates, decrease interest rates, or hold them the same? What would your advice be?
Our team right now is basically says there'll be no further rate cuts. As I said, inflation is coming down, but is a bigger fight. And at the end of the day, there's the dual mandate, employment, inflation. Employment, they're in great shape on. Inflation, it's been coming down, it's working its way down. It takes multiple years to squeeze inflation out. They started in 22, and so think of 26 is actually a normal period to squeeze it out. And there's a drag on the economy today. And so you're seeing economic growth from 3% in the last couple of quarters to 2%. We have it moving down to 2%. So he shouldn't, our expectation is they won't cut rates. I think we have
for the whole rest of the year.
Yeah, for the rest of the year and the next year, and frankly, until inflation gets down.
And, okay. So let me ask you, the business that my firm has been in is private equity, but now private equity firms have become private credit firms as well. And private credit firms, they lend money, but they're not regulated quite the way you are. Right. So is that a source of concern that we can lend money and we're not as highly regulated as you are, and you're lending money, but you're highly regulated, or you don't care about that?
I think I care about your firm. Look, at the end of the day, the private capital has grown because they can do something we can't along a couple dimensions. One is they can finance companies that may have more leverage. And we are basically stopped out at 6 times leverage. And that used to be a rule, then it was taken back, then it was a guidance, and then it was like, wait till we examine you. And we do go above it for certain credits and stuff like that. So that's one thing. The second thing is the ability to bring the whole capital structure, debt, equity, the whole, mezzanine, the whole 9 yards. That's hard for a bank because we don't engage in the equity business. But on top of that, we have $1 trillion of commercial loan commitments, $500 million plus of drawn loans. We don't fear any competitor, and we work with those companies, including yours, to generate assets for them. But it's just a different style. I think the world should be concerned to make sure that those enterprises making loans to billion-dollar operating company, have the ability to work with them in times of stress? That's going to be an interesting question. We haven't gone through a stress period with this practice out there.
I think J.P. Morgan, maybe other banks, maybe you have gone out and raised private credit funds that you can then lend out without the normal constraints that you have with the money you have from depositors. Is that something you've done, or you think it's a good idea?
We've created some capacity. In the end of the day, the credit we're willing to do is important as much as we can. So we have, we're dying for more loans. We have $2 trillion of deposits and $1 trillion of loans. We're trying to do all the loans we think have good credit quality, and so we don't feel it as constrained.
Right, so let's talk about your background. I am an only child.
Yeah.
You have how many siblings?
7.
7. So, growing up with 8 people in a family, wasn't that crowded at times, or?
I'm trying to think. I didn't have. I was set up to get my own bedroom for the first time in my life, and my younger brother decided he wanted to move in the bedroom because he was scared to sleep alone. So I think, I'm trying to think, probably when I was in college, it was the first time I ever had a bedroom to myself. So yes, it was crowded.
So what did your father do to support 8 children? Might see in private equity or something important like that?
He was a research chemist for DuPont, and so he spent his whole life on plastic. So the graduate, plastics young man, my dad was that. That's what he did.
You grew up in Ohio.
Yeah.
And then you went to college in the East Coast.
Yeah.
And at Brown.
Yes.
And you were the co-captain of the rugby team.
Yes.
And do you still play rugby or not so much?
No, I don't play. I played rugby at Brown. I played rugby at law school, and I played rugby after. It's a great sport. Having never played it until I played it at college. It is, in a way, the most intense. What looks like disorganization out there is extremely organized, but it's unique in that it's physical and tackling. You kick, you run. Everybody gets to handle the ball, and you run for 80 minutes. And so it's a very demanding game. And so it was a lot of fun.
Okay, so now you are the chancellor of Brown University, which means the chairman of the board, essentially. Yeah. So how do you have time for that?
Well, I've been on the board for 15 years, and at the end of the day, the chair of a board, Chris Paxson, runs the university, does a spectacular job, and our job is to govern and not, not.
So after you graduated from Brown, you went to law school at Notre Dame?
Yeah. Yes, sir.
And, okay. And did you play rugby at Notre Dame?
I did.
Okay. So then you went to practice law back in Rhode Island, is that right? Why did you move back to Rhode Island? You're from Ohio. You went to Notre Dame and the Midwest. Why did you go back to Rhode Island?
Well, none of the Boston law firms would hire a person from Notre Dame Law School, so I had.
Oh, okay.
It's hard to believe, but literally, I was the first lawyer hired by the firm in Rhode Island from Notre Dame, and they did it more because I had the Brown, connection stuff. But the big law firms in Boston, just even with one of my teammates working there, a fellow named John LeClaire, they couldn't convince him to hire me. So I ended up in a great law firm and had a great short legal career there.
Right. So I'm a big fan of people who are lawyers getting out of law and going into finance. So
I can empathize with you.
Okay, so you're practicing law, you're minding your own business. I assume you're a good lawyer. What kind of, were you a corporate lawyer, litigator?
Well, this is an interesting thing, Dave. When I came out of law school, when I went to law school, I was going to be a criminal lawyer because it was F. Lee Bailey was the talk of the world at that point, or I was going to be a labor lawyer. And then I went to law school, and I went to a firm, and oddly enough, I went to law school from 81 to 84. There were no corporate lawyers in America because it was before the 80s took off. And after the 70s, the activity died. So being a person that is impatient in life, I said, why don't I be a corporate lawyer? Much to the chagrin of the litigation lawyers and stuff who thought that I'd lost my gourd. So I became a corporate lawyer more by, I could see the opportunity to get responsibility, and I did that for 9 years and became a partner.
So how did you escape from being a corporate lawyer? What did you do?
There was a fellow named, one of my mentors is named Terry Murray, who ran Fleet. And I did corporate law, a lot of work I did for Fleet. And then Terry, after we did a transaction called the Bank of New England transaction with KKR, put money into the bank industry, and we bought the Bank of New England, meaning Fleet bought the Bank of New England from the federal government in the early 90s after the real estate crisis. I'd structured that deal in a way that I'd structured private equity deals for our private equity firm, which was a thing called dual convertible preferred stock. It convert into parent company stock or bank stock. never been done in a public array. Terry said to the general counsel, he's too smart to be a lawyer, which I never figured out what the general counsel thought about. He was a brilliant guy. And he said, get him in here, and we'll figure out if he's going to do something. So I
went to work at Fleet, which is headquartered in Rhode Island.
I just went to work for Fleet, and I was deputy general counsel for like 3 months, and I went on a special project to re-engineer the company and became the head of
And then
strategy.
Fleet ultimately merged with Bank Boston. And how did you survive that?
Well, that was the last deal I did. I was the head of M&A and strategy, and Terry Murray and Chad Gifford put together that deal, and Chad took a liking to me. I was an acquired.
Chad Gifford, who was the head of Bank Boston.
I was acquired taste for Chad because I was in the middle of negotiating, getting all the cost structure and getting the alignment, and I was meant to be the pain in the butt. And so Chad ultimately took a liking to me, was a great mentor, and said, you got to run a business, and put me in running a business. And we were merging two companies together, and I survived and ran the wealth management business for a few years.
You ran the wealth management business for the combined Bank Boston Fleet.
Yeah.
And then Bank Boston Fleet combined company was sold to Bank of America.
In 2003 fall, yeah.
And so how did you survive that one?
Well, they asked me to run the wealth management business, the combined companies, and I did that. And Ken Lewis wanted to integrate some of the people, because the companies were maybe 60-40, but they're very sizable companies, and so he was trying to get a management team that represented both companies, and so Chad was chair, and Ken was CEO, and I went and ran the wealth management business of the combined company.
Right, but then you became the general counsel.
For 40 days.
For how long?
40 days and 40 nights.
All right, so you became the general counsel of the combined Bank of America.
Yeah.
And then?
Well, so what happened was, in December of 2008, remember we bought Merrill on the Lehman weekend and everything, so we were originally trying to buy Lehman. We said we couldn't do it as a company. I was running at that point the corporate investment bank and other parts of Bank of America. We couldn't do that. And then over the weekend, that's when the world became very ugly. And so we bought Merrill, and remember Morgan Stanley got investment from the Japanese bank, and investments were made around. And so after that, I'm sort of running the integration, a bunch of stuff as we're going through from October or whatever it was till the fall. And then around the time Merrill showed up with a $7 billion loss in the quarter, with a lot less capital they're supposed to have, we started telling the government we couldn't do the deal and stuff. And so Ken asked me to be general counsel because we were eliminating a lot of jobs, and I actually eliminated my job. And I was basically out of the company. He said, you know what, stay and become general counsel because we need somebody. And from December 9th to...
All right, so you became the general counsel of the combined Bank of America.
As we negotiated with the government to figure out how to get the Merrill deal done, and then I went back in business right after.
But then you left after that for a while.
No, I became... So then in mid-January of 2009, I took over a bunch of the businesses after John Thain left and went back into business. And then by the end of 2009, I'm CEO. I had a lot of jobs in a short period of time.
All right, so now...
It wasn't what somebody should do.
Now, you bought Merrill Lynch at a discount, I guess, or low price, but it turned out to be a pretty good deal, I guess, right?
From an operating base, it was always a good deal. The issue was that the hole in their capital cost us some dilution. So, and we worked through that over time. So, with new capital rules and everything, we had about 7.5, 8 billion shares at the time. We went up to almost 12 billion. Now we're down to about 7.4. So we're back down to where we should have been. But it took a lot of work through all. But from an operating base, it was always a home run.
Right, before your bank came back from a rough position, you borrowed, in effect, $5 billion from Warren Buffett. Is that right? More or less?
Yeah.
And it was pretty expensive capital, some people say. So did Warren Buffett get a better deal? Did the Bank of America get a better deal out of that?
Well, our stock was trading at $5. He converted at $7.14 a share. So it was a class of 20%. But he had a 6% dividend. We were paying low dividend. But if you bought the common or the preferred had a 10% dividend that day. The common, you would have done better because you would have picked up more the first $2. So you picked up 40.
Did you negotiate the deal with Warren Buffett, or is he pretty smart? Or?
It's apocryphal. He's told the story, so it's not my. But the idea came to him in the bathtub. He called up, got into the call center, believe it or not. then finally got someone to get a number, called me and said, I want to put $5 billion in your bank. And I said, we don't need the capital, Warren. He said, no, you don't. That's why I'm calling you. You need stability, and I can provide stability. And I said, yes, you can. The night before, a fellow named Mike Lyons, and now runs Pfizer, who was working for us at the time, and a fellow named Bruce Thompson and I were sitting there saying, we need to get some stability, because remember, what people think about is government shutdowns and defaults. The government was really in trouble in August of 2011. They couldn't come together in funding. They were starting to overdraft their accounts, let's just call it that. So that was going on, and then we were getting banged around because all the mortgage litigation. And so he came in, put the money in, and from then, from basically $5 share price up to $44, $45, whatever, it's been pretty unbroken since. So he's fared well, and we fared well.
Does he still have the stock, or has he sold most of it?
He sold about a third of it, and then he bought another 300 million shares. He ended up with 1 billion shares. He sold down to like 600 last I know. But he did very well, and we did very well, and he's been a great investor.
Let's talk about the beginning of Bank of America. So Bank of America started as Bank of Italy.
Yeah.
So who started Bank of America, and why did he name it after Italy as opposed to America?
Well, A.P. Giannini, who was Italian descent, started the Bank of Italy when he came to the country in San Francisco to help the Italian community that emigrated to San Francisco. And he became famous in the San Francisco earthquakes and fires in the early 1900s by setting up a barrel and starting to lend money. And then fast forward to 1999, when Nations Bank, which was the North Carolina Bank, which is the bank, the bank today, and the Bank of America merged, you had two good names. Nation Bank wasn't a bad bank name, but Bank of America was a better name. So they took the name, but the operating company that survived was Nations Bank.
So it moved from San Francisco headquarters to Charlotte headquarters, where you are headquartered now.
Yeah. And it's interesting because with the LA fires, we've asked our teammate Raul and I to step in, because we have a heritage in California helping in times of stress. That we have a big business in California, and Raul's doing a great job. But you do have this historical ways that we've done business around the world. We're the first bank to make a loan in Japan after World War II ended at the request of the U.S. government to start lending money. We've been in the UAE since it was formed. So you go back in heritage. It's just a wonderful heritage. And the Bank of Italy heritage is apocryphal because of Giannini. But the reality is the bank that survived all this and drove all this was the North Carolina Bank, which formed to bring capital to the Southeast as it grew because the New York bankers wouldn't come down and do as much business. That is the bank that survived all this. And so all these rivers came together and formed this huge river.
One of your predecessors as the head of Bank of America became the head of the World Bank at one point. You have any interest in being the head of the World Bank?
No, you've got Ajay coming in. I'll let him run that because I haven't been asked, and he does a great job. He'll be terrific for it.
So let me ask you about this. Banking today, why do we need all these bank facilities, bank
branches,
buildings,
financial centers?
Because everything is done online, it seems. Do you actually have a lot of buildings? Do you really need all those buildings you have where you have your bank?
This is the classic do as I do, not as I say. Because at the end of the day, between this morning when the banks open up to tomorrow morning, 400,000 people come into our branches. So this idea that nobody goes to a bank branch just is not true. The idea that nobody uses cash, well, about $250 million will go out of our ATM machines in the next 24 hours. The idea that nobody writes checks, there are 100 million checks.
How many banks do you have around the country now?
We have 3,700. We went from 6,000 down to 3,730.
And what about ATMs? You have a lot of them?
We have about 14,000 of them. At the high point, we had 18,000. And that's technology. In the end of the day, the huge technology impact in banking over a long period of time, but since the team started in 2010 coming together, really started a few years before that, we have been basically engineering the head count, the facilities. We had 120 million square feet of real estate in 2010. We have about 70 million today.
Hey, now, have you ever gone to get money out of an ATM and been denied?
Not since college during the Great Blizzard of 78, when we were at the wrong. We had a friend gave us an ATM card to go out and get some money to buy liquor before everything shut down, and we went to the wrong bank.
What about
give us some money?
What about credit cards? You ever had your credit card denied?
Not that I'm aware of, but so hopefully nobody else has that shouldn't have been either.
How has the world of technology affected the banking world? So right now, so-called fintech. Has fintech dramatically changed the way Bank of America operates?
So we invest about $4 billion in new code every year. Every weekend, we'll have a couple million lines of code go in to amend our systems and change our systems or add new technology. That's not to run the systems. That's another $8 or $9 billion. That is just new activity. So the impacts have been unbelievable. But people it's still human beings and what they do and how they do it. So you have to be high touch and high tech. So in the mid-90s, when I was the head of strategy for the company, I remember consultants coming and saying, 20 years there'll be no bank branches. Well, it's 30 years, and guess what? We still have 3,700 and stuff. The reality is people want it all the ways. So, but the impact of the phone, the iPhone in particular, was so different. And we were the first app available on the iPhone. And the reason why is we built our technology through someone's prescience in the company to be a web-based technology back when people didn't do that. It was really an app-based technology. So it could be made an app back. We don't think of these things today, but back then that was an unusual thing to have an app. Everybody went to the websites, et cetera. So that took off. And so from that start, you now have 40 million consumers who bank digitally with us all the time. Last year we had about 90+% of our interactions with consumers are digital. And yet the critical importance of a person going into one of our stores and saying, I got to figure out how to save more money. Can you help me do a financial plan? My mother's sick. I've got a power of attorney. I need you to figure out how I can manage her affairs. My kid wants to go to college. I need to figure out how to borrow the money. All those things are critically important, so you have to be able to do both.
So people still writing checks the way they did 10, 20, 30 years ago? Is that a big business for you, check cashing?
Check cashing is not a business. It's a convenience for the customer. The checks written from like 2019 and now are probably down 30 or 40%. There's still a fair amount of them. What you've seen is a dollar volume written stays flat, but the number written comes down. And we track that literally every week, but we track all our spending every week, but we can see what's going on in the American consumer. But in the dynamic there is people are still paying their rent or the mortgage or something like that, car payment with it. What they've done with Zelle, which didn't exist a decade ago and now is the dominant force. Our clients send more money over Zelle than total Venmo is sent, to give you a sense. And so it's become the dominant way. That's replaced a lot of small dollar checks, but the big dollar checks still go through the system.
In the old days, when I used to write a check, the bank eventually would send me back the canceled check. What happened to those canceled checks? Where do you keep them all now?
They're all document destruction policies, but they're all image-based. So even if you went to a branch and deposit a check, it's image-based right then, the actual check's destroyed. The idea of taking a check deposit ATM, so about 15% of the bank's checks are deposited at the physical ATM, a lot of small business activity. The other, let's call it 85%, about 50% of it goes through mobile, taking a picture of it, which is you imaging the check. The other 30% goes through the ATMs, which the ATM takes a picture of the check. The check disappears in all cases.
So if I want to go to use an ATM and I have a Bank of America ATM card, but I don't see any Bank of America ATMs, I go to some other bank ATM, I pay a fee. Is that
you wouldn't, David, because you're
what?
You wouldn't, but other people might.
I thought you had to pay a fee. I mean, is that a profit center for banks? Those fees, or
no? At the end of the day, we get 55% of our revenue, our $100 billion of revenue last year. 55% came from interest, 45% came from fees. The dominant part of those fees are trading revenue and asset management fees and things like that. We have consumer fees, but they've come down dramatically because basically we said to the consumer is, you keep changing your behavior, we keep driving down the cost to serve, and we'll give that back by lower and lower fee structure. So we have a no-fee checking account. We have a $5 simple checking account that people know that you can't overdraft. We do our overdraft fees when we first started changing our policies 15 years ago were $5 billion a year, and now they're $120 million a year.
Do you think we will have in our collective lifetime no more currency, everything will be digital, or you think that's not likely?
Not in our lifetime.
What about a digital currency, which doesn't preclude other things, but a digital currency?
Well, I think the new administration wants to push, so you have to think about three parts of this dialogue. There's the blockchain question, there's the stable coin type of currency question, and then there's the Bitcoin and other types of things. It's pretty clear there's going to be a stable coin, which is going to be a fully dollar-backed, type of thing, which is no different than a money market fund with check access, is no different than a bank account, really. And so, if they make that legal, we'll go into that business. So you'll have a Bank of America coin and a U.S. dollar deposit, and we'll be able to move them back and forth because now it hasn't been legal for us to do it, but it's just done like another foreign currency. The question of what it's useful for is going to be interesting.
Right. So in the old days, 10, 20, 30 years ago, if you had a lot of coins, you put them in a jar or your desk, and eventually you could wrap them up and take them to the bank. Now, if you go to the bank, they don't want the coins.
Well,
what do you do with these coins now?
We're going to get rid of the pennies, so maybe the other day, if you roll them and bring them in, they'll count them up and stuff. But it's a tricky thing because it's just a lot of work for.
Okay. So now President Trump said we're not going to make the penny anymore.
We'll take all your coins. Don't worry.
Okay. The penny. What about the penny? We don't making the penny. Is that a problem?
I think the economics that they're talking about is it costs more to distribute them. Look, at the end of the day, when you think about the bills, the currency, and whether it's coin or bills, and it's mostly bills in terms of value, it's an interesting thing. So 98% of all the bills that move around the world, we move on a day as a service to the government. Right. And there's nothing bigger than 100. So $1 billion of hundreds weighs a few tons. $1 million of hundreds is a 25-foot stack. So there's a big physical part of this. Now, the reality is that's done for reserve currency and central banks. That's who holds it. The rest of the money all moves digitally today. So we'll move $3 trillion today digitally. So the idea in our consumers' money movement is dominated digitally, whether it's a Zelle payment, a wire, an ACH. At the end of the day, that doesn't include credit and debit cards, which would take another big part because at the end of the day, what's a debit card? It's just an introduction to digital. So getting rid of pennies and stuff, there's economic support, but the reality is we'll always have currency because that represents.
And what's the most common currency? Is it a $100 bill or the $1 bill?
I don't know that, but I'm sure there's more ones than hundreds. But at the end of the day, all the big, the real money movement to the central banks is all the hundreds. It's palleted to hundreds. It's a wild scene to watch, pallets go through this. We go to the Federal Reserve, we pick up these pallets of cash and send them around to the Central Bank of, France to have their reserves.
Well, when you need cash, do you go to the bank and get cash at the end of the week, or do you just go to the ATM, or you don't use cash so much?
I do everything every one of our clients does. Look, at the end of the day, I often go and say hi to the teammates because that's kind of fun. So I try. If the bank's open, I'll go and say hello and get some money out. But at the end of the day, like you, like me, like everybody, you become, if you look at the way the money. So year to date, about 7% more money got moved by Bank of America consumers over last year. So that's pretty healthy. If you look, 25% went by credit card payments. And about 14% went by checks and Zelle and other stuff. Cash was probably in the high single digits. So it's not a lot of cash goes out of the ATMs every day when you put it against these other payments. So $4.5 trillion will go out in cash. How the ATM today is a couple $100 million, and that's going on an economy being spent. So the healthy consumer spends money, and that's good, but they use all the devices. Cash is becoming less, but it's still critically important. And so that's why we have ATMs, and that's why we have branches, and that's small businesses receive cash especially and bring it in deposit, and that's why you need a physical plan.
So if I go to your bank and I want to make a deposit of $10,000 in cash, I'm going to get reported to the federal government.
Yes.
And 10,000 isn't what it used to be.
Well, so one of the reforms we're saying is, and somebody testified a few weeks ago to this fact, so I'm paraphrasing their story, is they said when 1972 they set the $10,000 level. The theory even goes back to the 40s, but let's just say 1972. In 1972, you could buy a fully loaded Cadillac for $10,000. We're now this many years later, and we still report not only if you did 10,000, but if you did 3 or 4 transactions in a period of time that looked like you were trying to evade the 10,000, we'd have to report that too. One of the simple answers we're saying, just index that to where it should be, which would be like 100,000. When you do that, that takes out all this activity and moves it away. And $100,000 is the inflation-adjusted amount from 50 years ago for 10, or maybe 78 or 80,000. And so if you're saying lift that amount, you'll take the average transactor completely off the table, and you really will be looking for people who are trying to move significant amounts of money or avoid the transaction level. It's such a simple fix, and I think people can see that. And by the way, in 20 or 22, there was an act passed that became law that gave the authority to Treasury to do that. They just need to do it now.
Right. So now you live in the Boston area, as you have for many, many years. The biggest headquarters office I think you have, or financial center office, is in New York, and your headquarters is in
Charlotte.
Charlotte.
Yeah.
So is that inconvenient for you to go all these different places?
No, it's not, because we also travel all over. Like, I'm here today, I'll be in Florida for a couple of days, and et cetera. So we move all over as executives in big companies, and you do too. But the idea of moving people around and moving their, where they work and moving their families, it's more difficult than 20 years ago, when we said we're moving the headquarters to Boston 30 years ago, you just got to move. Right. It was not a question that you said, oh, maybe I got a better idea. So as we look across that, we have 16,000 plus people in Charlotte. We have about the same amount when you take New York and the areas around New York. But we also have 5,000 people in Boston. Around there, we have 35,000 to 40,000 people in the state of California. We have 30,000 people in Texas. So Florida, we have operations centers in Jacksonville. So you have people everywhere. And the idea is we try to always look at it and level load, activity around the country to avoid, to use time zone differences to our advantage for call centers and to access talent pools. And then remember, all our branches, our private banking teammates, our Merrill teammates, and our business lending teammates across all the businesses, they're all in the field. They're in 9,700 markets out there every day.
So if I wanted to make an investment in a bank stock, would you say it's a good idea to invest in bank stocks now, or do you think bank stocks may be overvalued, or what do you think?
Our valuation difference to the S&P is lower than it's been, and I think our company is a great value, and the rest of the banks are pretty good value.
Okay, so now, when you took over the bank, you had more employees than you have today. Yeah. The bank has expanded. Why do you have fewer employees? Because your bank's so much bigger.
So that's technology, and that's applied technology. So in 2010, we opened with 284,000 employees. We went up to 305,000 to peak, and we ran as low as 204,000. Now we're about 213,000. And so all that was done with applied technology and digitization, new technologies, both. So if you think about work, the way to get rid of work is to eliminate and re-engineer the work and eliminate steps and things like that. You can do that through automation. You can do that through just not doing them, et cetera. Avoid duplication. Then you can eliminate management of work, because if you have less people, you need less managers. And then you eliminate the real estate that people sit in. And so we've been doing that on and on again. But the key to make it really move was technology. Right. And so whereas we had, in 2010, we would have had 5,500 branches. We now have 3,700 branches. We actually have probably almost 1,000 of those in places we did not have branches back then, in different cities. And so if you think about maybe 600 or 700 like that, so you think about that, those branches are bigger and more efficient, but all the transactions that come out, right, and what's in there is sales activity and relationship activity. And so it's just that constant re-engineering. We have this thing called OpEx. Every year we come up with thousands of ideas to take out and re-engineer the company. And so at the end of the day, more customers, more activity, more people, and yet you've driven the head count down, and our costs are 2/3 people. And then basically the other third is some advertising, the buildings, and some technology and electricity.
Now, there's an acronym today that some people in Washington don't like called DEI. Yeah. Do you have a DEI policy or not anymore?
We had diversity inclusion in our company, but let's step back. What we've always been is a bank of opportunity. So we think about creating an opportunity for our teammates. And how do we do that? We go out and hire from all areas and bring people into our company. So we go to 400 different schools to recruit kids. We have a program we call Pathways. So Pathways we announced in 2018. We said we'd hire 10,000 people from low and moderate income neighborhoods to come work in our company. We completed the first 10,000. Then we went out and said we'll do another 10,000. We're up to 30,000 people over the last decade almost that we've hired from LMI communities to come work for our company, from high school, junior college, and colleges to come work. So once we have a very diverse company in terms of representation from all economic stratas, all races, all ethnicities, once they get in, the opportunity is there of a lifetime. We equal pay for equal work, the ability to promote, we train, we do all the work. And so the idea is that's an opportunity. When we look outside our company, we try to work with other employers to create the same opportunity we create. We try to work with nonprofits and communities to create opportunity for them to be successful. And so the idea is just create opportunity. So we have a diverse team. We stress inclusion. So when you're at our company, you can be who you want to be and be successful, including we have 300,000 memberships in our employee resource groups, of which about 60% of the people are in one. The average S&P 500 company has 5% employees. Our employees love to work together. They're open to all, even though a cohort. And so we just try to create opportunity.
So a young person is graduating college. Why should they go into the banking profession as opposed to private equity, investment banking, healthcare? What's the appeal of working in a bank?
Well, when we bring the 2,000 kids in and I talk to them, I always say the same thing. You can make a lot of money doing a lot of things. You can have a great career doing a lot of things. But if you're going to come to our company, you really want to help people. You want to provide the answer. Our market position is, what would you like the power to do? And I said, your job at this company is to help people answer that question, whether it's a customer, whether it's a teammate, whether it's a shareholder, whether it's a community. And you got to come and want to do that. You want to deliver a lot of profits done the right way with a purpose around it. And if that's what makes a place special, and our turnover rate's an all-time low, and we are sought after by young kids to work. So you hear everybody's going to tech companies and stuff. We have hundreds of thousands of applications for the 3,000 we hire.
Your Bank of America is mostly focused in America, I assume, but do you have a lot of business outside, and do you want more business outside of the United States?
Yeah, we do business in 130 countries. We're in 30, 40 core countries. We've been in, like I said, in Japan for 80 years now, in India for 65 years, and Brazil since 1954, and Argentina since 1914. So we have an international business, and the amount of loans we have outside the United States for commercial customers exceeds what we have in the United States for large corporate customers. So we're a global business for global investors, global firms, private equity firms, global investors, global companies. And so we do investment banking, corporate banking, treasury, cash management, and trading across the world. And we're top 2 or 3 in the world in these businesses, going back to your earlier point, that the U.S. companies that come to dominate those businesses, we're right at the top.
Were you ever at a cocktail party or a lunch and somebody gives you a resume? Does that ever happen to you, if somebody they think should be hired by the bank?
There's this thing called email that gets them there faster nowadays.
All right. And what now, on a personal side, you've been there 15 years. You haven't announced any time that you might step back, and you're not prepared to announce that today, right?
No, I don't.
Okay. So
I'll tell you first, though, Dave.
Okay. So have you been able to convince your children to go in the banking world?
My oldest son's an investment banker for a different firm, obviously, and my middle child is a risk manager for another firm in financial services, and my younger's in communications and stuff. But I never said, look, being a CEO's child is not the easiest thing, being a CEO's spouse. So they saw me work in different ways across the years, and so it's their decision what their career is, and it's nice. My son, he's a deal doer. He's an M&A type of guy, so it's fun because I used to do that. I haven't done that in a long time.
What do you do for rest and relaxation, all your spare time?
I do what everybody else does.
And that was David Rubenstein speaking with Bank of America Chief Executive Officer Brian Moynihan at the Economic Club of Washington. And you can watch more of that interview on the David Rubenstein Show, Peer-to-Peer Conversations, on March 12th at 9 p.m. in New York. I'm Shonali Bassick alongside Katie Greifeld. You are watching Bloomberg Open Interest. Let's recalibrate here to the markets because, of course, we're less than a minute away from the opening bell. It's been a choppy trade this morning. Katie, what are you taking a look at?
Well, we saw that follow through to Friday's sell-off yesterday. There had been some optimism that we were going to be able to get off the mat, that those dip buyers would come in force. That didn't happen, Shonali, and you take a look at where we are this morning. We're trying on the S&P 500 to go green in the futures market. We were there briefly before the bell, but it looks like as we count down to the opening trade that it's going to be another volatile session. Of course, you've seen the reaction in the bond market to these growth fears just building and building. A big bid coming into the long end of the Treasury curve from the short end to the long end. That's not really giving a lot of solace to these equity bulls out there, because if the Fed has to cut rates because of slowing growth concerns, that's bad for equity markets too. But nevertheless, you take a look at the opening bells right now at the New York Stock Exchange, at the NASDAQ, no matter what the futures market is showing, we know that people will clap, and that's what we're seeing right now as we welcome in this Tuesday trading session. Just a couple seconds into the official start of this trading day, let's take a look at where we stand. The S&P 500, it's pretty much unchanged right now, as again, we're just a couple seconds into trading. That's not bad news necessarily when you think about the last few sessions that we've had. We do see a direction when it comes to big tech, though, and it's lower. The NASDAQ 100 currently off by about 0.2%. The small caps is a really interesting space right now. You can see the Russell 2000 really fighting to stay in positive territory, but this has been the biggest underperformer so far year to date. Even though we do have that big bond rally in the last couple of days, that should be good news for those small companies. But when you're worried about economic growth, maybe you don't want to be in the small caps. Meanwhile, we take a look under the hood here. Like I mentioned, tech stocks were sharply lower this morning before pairing some of those losses. NVIDIA down at the moment, though. That's as the Trump team weighs harsher China chip controls. Palantir, also a company we've been keeping a close eye on. It's trying to break its 4-day losing streak. Doesn't look like it's going to do it right now. Currently off by about 0.9%. And then you take a look at Bitcoin. We have IBIT up here. That is the BlackRock Bitcoin ETF. Currently off by about 5.6% because not even Bitcoin has been able to sort of escape this risk-off mood, Shonali.
Do we want a silver lining?
Let's find it.
NVIDIA results are tomorrow, and perhaps this lowers the bar just a little bit. Maybe. Anyways, we're looking at Home Depot this morning. Results were out, of course, and we have the stock up about 0.9%, almost 1%. Sales rebounded last quarter as interest rates dropped and Americans spent more on home improvement. Comparable sales grew nearly 1% last quarter, and Wall Street analysts expected a 1.7% drop. Guidance for 2025 remains cautious. Flip up the board here. I also want to look, this one's for you also, Katie. We're looking at Hims and Hers. Brutal day this morning, down almost 22% as the market opens. Profit and revenue came in above analyst estimates, but it announced it'll stop selling some compound weight loss drugs, including semaglutide. That's following the end of an FDA shortage. We're going to bring you more on that later this hour. Let's take a step back from the single stocks. Let's talk about the broader market moves with Bloomberg's Jess Menton. After 3 straight days of declines on the S&P 500, we drop below that 6,000 level. Where are the dip buyers?
Well, it's important, too, because if you look at some of the latest retail dip buying data from Emma Wu at JP Morgan, it's interesting because yesterday, the first hour and a half, you saw retail traders actually selling more than $1 billion here worth of those stocks. If you're thinking about some of the most single names, Palantir, as well as Alibaba, some of the ones they sold. But as the session went through, you saw them coming back in, and instead of selling, they were buying some of those stocks, but still on a net basis, they were selling over about $1 billion worth of those stocks. But that's interesting because I was talking to you as well as Katie a couple weeks ago when it comes to some of the dip buying trends that have changed somewhat this year. Instead of seeing that on Mondays and Fridays, just because there's a lot of headlines coming out of Washington on tariffs over the weekends, as well as some of the news when it came to DeepSeek just a few weeks ago. We're starting to see retail traders step back in midweek, but still, nonetheless, you're still seeing some of the sentiment indicators when it comes to retail traders still around all-time highs, ladies.
Yeah, I made a lot of hay with that stat, that Friday stat yesterday. And I mean, the pattern held. Friday and Monday were both pretty ugly sessions. Let's talk about how people are positioning, especially when it comes to the volatility market. You're taking a look at the VIX right now. We're trading with a 19 handle. That's below previous spikes of volatility that we've seen, but when you consider the one-year average, still pretty elevated.
It is, and it's about 20% over that one-year average. It's also trading at the highest so far this year when you're looking at that. And I was looking at CFTC data. Obviously, this gets updated on Fridays around 3:30, just before the closing bell. But for 17 consecutive weeks here, we're seeing hedge funds as well as large speculators positioning that basically they're expecting volatility to stay lower. The only thing, when we've seen different trends like that, say last summer, they ended up being caught wrong-footed whenever we had the unwinding of the carry trade. That's not to say something like that would happen right now, but the positioning based on the large speculators, they still think that volatility is going to remain lower from here.
All right, Jess Menton, always a master class. That is Bloomberg's Jess Menton. She covers equities for us at Bloomberg News. And let's keep this conversation going now with Barbara Ann Bernard. She is Windcrest Capital founder, CEO, and CIO. It's great to have you with us, Barbara Ann. So I want to talk about what's actually going on here. You have all these different theories as to what's driving markets down over the past couple days. Tariff concerns, growth concerns, maybe fears that we've reached peak AI in the U.S. What do you think is really the catalyst for these losses that we've seen?
Well, I think it's multifold. You're looking at peak concentration and very high valuations, so it doesn't take a lot to shake people out. And the trouble with how or what has worked in 23 and 24 is it was a lot of momentum trading. It was a lot of passive investing, which made the big bigger. And when you're not investing on the basis of fundamentals, it's easy to get shaken out because if momentum reverses, what do? You sell. So you see Bitcoin down today, you see AI. And the reason is, you're like, if you think about the NASDAQ trading on 37 times future earnings, there's the risk that those future earnings get disrupted by technology itself, right? I don't think that's a safe investment. And then if you look at the S&P 500, it's struggling because the top stocks are so tech weighted today. And so what you're seeing is a shift out of the tech into free cash flow. And I think that's a very healthy thing for the market. And so I'm not excited about the index levels, but I am excited about the portfolios you can build if you're investing on the basis of fundamentals.
Speaking of portfolios, Katie made this great point yesterday that diversification is back, even if you believe the bond market is showing a bid because you're worried about growth and it's driving yields down. At least there's somewhere to go. But what I want to point out is you have a 10-year that is just above 430, and you have a market that's not significantly reacting to it. What's going to benefit if we do see rates decline? Or do you worry too much about growth to see that benefit from interest rates being lower across the curve?
So I think interest rates are declining, but I don't see a sharp cut or, so I think rates will stay. They're coming off a high base, but we're getting to a more normalized scenario. And that's what Brian Moynihan was talking about. He doesn't see rates cuts this year. So he believes his net interest margin will be fine. And if you look across the world, growth is slowing, which is all the more reason that you need to have solid business models, right? So I like companies that are utility-like with strong fundamentals and strong free cash flow. Bank of America is a good example. It trades at half the PE of the market with twice the dividend, right? And so when you talk about diversification, the biggest way to diversify is out of the US. That is the most expensive market right now, but that has been very unpopular until this year. And so you're seeing EM and you're seeing international outperform, and I expect that to continue. And so let me just break this down for you, because I can build a portfolio today that trades on half the PE of the S&P with 3 times the dividend yield and 4 times the free cash flow. And the reason that free cash flow is so important is the difference between a 1% and a 10% free cash flow yield is the ability to pay back the equity and bond investors all of their money in either 10 years if you have a 10% free cash flow yield, or 100 years if you have a 1% free cash flow yield. And the things that have been working are the growth stocks, right? The promise of free cash flow in 100 years. That's not going to work. So what is working is that beautiful little LBO candidate with good growth, good balance sheet, and the ability to pay back via dividends, via buybacks, and just conservative business models. So I can't control global growth, but I can control the stocks I pick.
That's a great point, that there are gems to be found. You just have to do a little bit of legwork. I want to stay international, though. I'm glad you brought that up because it feels like one of the themes that has emerged in the past couple of weeks is this cracking, if you want to call it, of the America exceptionalism trade. And you take a look at the Citi Economic Surprise Index. It's actually flipped into negative territory for the first time in a while. And I'm wondering how much of this trade, this rotation into international stocks, is just that the American side of things is looking not too great relative to recent history versus actual fundamentals in other countries being strong. We had this conversation with Maria Waitman of State Street last week, and she said she doesn't think this is sustainable because it's not like European fundamentals are in a great place. I'm wondering how you're comparing the relative factors there.
So I wouldn't bet against America, right? It's a phenomenal country with phenomenal opportunity. What I would say is it's expensive today vis-a-vis the rest of the world. So my call is on valuation metrics alone. But Trump is running the U.S. like a company. That's really refreshing. I mean, and if you think about it, what the U.S. is undergoing right now is a restructuring. People and markets hate change. So if you look at the tariffs, he's just renegotiating his buyer and supplier contracts, right? If you look at what Doge is doing, he's looking at the expenses and trying to trim the fat at the government level. Well, no one's ever accused the government of being run efficiently. That's probably a good thing. And then he's trying to increase his top line. You look at what Apple did with the reshoring of jobs and in America. Those are all good things. I think the U.S. is going to be stronger because of this, but it's that the market had such a run from the election to here that we have to grow into those multiples. And so you need to see earnings come forward. And you can't really do that in a quarter or two. This is a longer term, plan. So I'm underweight the U.S., but I'm not, I definitely want some exposure there and overweight emerging markets.
Speaking of valuation, I want to pull up here a chart of the S&P 500 versus what the Magnificent Seven have been doing, because you're looking at an S&P 500 that is about 2.5% or so off of its high, but the outperformance relative to the Mag 7 this year is pretty stunning. The Mag 7 has been quite a dog, frankly. At what point do you buy that dip?
You don't. I would short it. It's not done yet. If you look at the S&P in 23 and 24, X the Mag 7, the S&P was up 4% in 2023 and 6% in 2024, right? The only thing that worked in 23 and 24 was the Mag 7. That trade is over. Cash is king. Show me the money. Where's the free cash flow? Hope is not a strategy. And like I say, the tech companies, the biggest risk is that their earnings themselves get disrupted by new technology. That's what the DeepSeek threat was, right? You've already seen it. And I say it again, the problem with investing on a narrative or a theme or on the basis of fund flows is it's easy to get shaken out when when your fear surpasses your greed, right? If I have a stock and they're great fundamentals and it sells off, I buy more. If I have a stock that I've just bought because everyone else is, and it sells down, I need to hit that sell button and get out first, right? So it's a psychological thing. And I hate to say it, I mean, the way I invest has been out of fashion for the last 10 years. And I think a higher cost of capital is driving greater discipline in companies. And maybe this is the year where value investing is really rewarded and people who do the homework come out with a better result.
Barbara, we thank you for joining us today. That is Barbara Ann Bernard of Windcrest Capital. Back to the basics, Katie, is where we are headed. And
some fighting words, too, for the Magnificent Seven ahead of NVIDIA earnings. Excited to see how that plays out.
And as you've been pointing out, it's pretty close to correction territory. Maybe a little bit of investors waiting to see if we hit that point. Now, coming up, Hims and Hers plunging in the early trade while Novo rises. We're going to look at the weight loss drugs in the market next. This is Bloomberg.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race. And Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank.
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
All right, it's time now for Top Calls. Some of the analyst action in focus this morning. And first up, we have Walmart getting raised to a buy over at DZ Bank. That is despite that uncertain outlook from the discount retailer. Walmart's lower than expected profit forecast raising some concerns about the retail sector and consumer spending. Next up, Block no longer a sell over at Morgan Stanley. The firm is raising its view on the digital payments company in the wake of its results, which triggered, of course, quite a sell-off. And finally, Hims & Hers Health, no longer a buy over at Nephron Research. The company said that it will soon stop selling some compound weight loss drugs last night, and that move comes as Novo's Ozempic came off the U.S. drug shortage list on Friday. Let's get some more insight now into what's going on with Hims & Hers with Bloomberg Health reporter Madison Moeller. So, Madison, are they completely out of this business then? Because this has been quite a boon.
Yeah, so they are not completely out of the business of selling weight loss drugs. Hims is still expecting to continue selling personalized doses of Novo's Ozempic and Wegovy this year. What that means is they're basically going to tweak the dosage of these drugs to sell dosages that are not commercially available through Novo Nordisk. They're also planning to potentially tweak the formulation a bit by adding vitamins, things like that. We're seeing other companies doing that. They're also expecting to continue selling oral weight loss drugs, which are some older generic versions of weight loss drugs, and Novo Nordisk's Saxenda, a copycat version of that, which is an older weight loss shot that's a little bit less effective.
So is all of that enough to get them to their 2025 sales guidance? Because if you think about the math, I mean, they're expecting revenue to be between $2.3 billion to $2.4 billion this year. That is ahead of Wall Street expectations, and it feels like they're losing a pretty valuable chunk of their business here.
Yeah, that was, I think, the question that investors had last night because they were trying to make the math work, as we were talking about earlier. And what Hims sort of has emphasized is that weight loss drugs actually aren't the biggest part of their business. Last year, they did $1.5 billion in sales. $1.2 billion of that was not from weight loss drugs. It was from their other offerings in erectile dysfunction, hair loss, skincare, dermatology, all of these different things. So they are trying to emphasize that they have this other businesses that are doing quite well, and that the loss of Novo Nordisk's some doses of their drugs won't affect them that much going forward.
And I'll point out, Shonali, that this stock has been on absolute fire. Through yesterday's close, up by about 112%. It's going to have a big bite taken out of it today, but still quite a run.
Yeah, and you have to wonder what's next for it after that kind of a drop-off. But I also want to go to Eli Lilly as well, because the news this morning that they are reducing the cost of certain vials to $50 less. I'm quite literally sitting in Matt Miller's seat. So I have to ask you how much price pressure there is in this industry, and should consumers be waiting till it's $100 less?
Yeah, it's a good question, and definitely a Matt question. But so Lilly is doing this in part to offer more accessible options to people who don't have insurance coverage for weight loss drugs, like people on Medicare, which still does not cover obesity drugs, period. And so what they're doing is they started offering these vials last year as a lower cost option. They're further reducing the price of that. They're saying is sort of in response to what they're hearing from patients and consumers, which is that even though they have this lower cost option, it's hard to compete with these compounded drugs that really cost even less than what Lilly's offering. So they're bringing down the price a little bit. They're also launching 2 new vial formulations, higher doses, so that people, because remember these drugs, you start at a low dose and you step up to higher strengths as you go. And so they're launching these additional formulations so that people have more options, and maybe it is worth waiting for the lower cost options because they're coming.
All right, well, we'll make sure to pass that on to Matt. Great reporting, as always, Madison. That is Bloomberg's Madison Moeller. Now, coming up, the carry trade and the basis trade in the crosshairs of the world's top financial stability watchdog. Details next in our Wall Street Beat. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Welcome back to Open Interest. A quick check on markets because we're now at session lows on the S&P 500, down about 0.4%. You can see that bond rally extending. 10-year Treasury yields down about 8 basis points, and the VIX now trading with a 20 handle. I do want to mention tech, though, because that's where a lot of this pain is being felt, with the NASDAQ 100 also off by about 0.9%. And officially, Shonali, the Bloomberg Magnificent 7 Index extending its fall. We have hit 10% on that drawdown. That means we are officially in correction territory. So the pain obviously has been really in these big mega cap tech companies companies, and all eyes are on Jensen Huang taking the stage tomorrow.
Yeah, the market could really use him for a save. We've been wondering if that correction level would bring in the dip buyers, but momentum might not be on its side. Now it's time now for the Wall Street Beat. The Financial Stability Board, the world's top financial stability watchdog, is setting up a task force to identify areas where shadow banks could spark a broader crisis. They're focusing on high-risk areas such as the carry trade and the basis trade. Bloomberg's corporate finance czar, Neil Callanan, joins us from London. Neil, I want to just pull up a 1 year of the VIX. We're at 20 now, but some might remember last summer when it spiked significantly. I think it ended the day around 65, or it hit it intraday, but you could see just that moment where markets went haywire. It didn't get systemic at the time, but I would argue here that not just the carry trade had the ability to have broader effects. The basis trade, with yields where they are there worries starting to come back to the market with bond market volatility starting to really upset the way hedge funds are operating in the space?
Yeah, absolutely. There's a growing concern about the amount of leverage in the system, particularly when you see these moments where everything seems to be okay. It's at that time that often the unexpected happens, right? And when you have hedge funds borrowing at up to 50 times their asset value in order to invest in these trades, it doesn't take much for things to go wrong and that to have knock-on consequences for the financial stability and the financial system. And the FSB is obviously stepping up here and saying they're going to set up this task force to look at these trades with a view to ensuring that we don't have big blow-ups. People will obviously have memories of Archegos as well. Different thing, but it just shows how quickly problems in a small area of the market can become much bigger problems.
Neil, I think a lot of people forget in 2019, the Fed did have to intervene in this market when repo really blew out. They had to intervene again in 2020. Many argue that was COVID, but still there was a problem here with leverage. And it used to be that hedge funds would run 50 to 1 on leverage in this space. Could you argue that some of that running wild has been reined in anyways?
I think people are more conscious of it, and certainly once you tend to get a regulator view and regulator scrutiny, people tend to pull back. So the most recent data we've seen involves ESMA, which is the European Securities Agency, and what they found is that leverage is about 18 times on some of the trades. And that obviously is an indication that there's still very, very high leverage, but perhaps something of a pullback from what went before.
All right, Neil, great reporting. Appreciate your time. That is Bloomberg's Neil Callanan. Now, coming up in the next hour, I'm pleased to say we'll be joined by Nancy Tengler on these markets and this tech sell-off. Also by Blackstone's Joe Barata, as well as Compass Diversified's CEO. All of that and more coming up. Don't go anywhere. This is Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
what's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow. I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice then to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No. Myself, 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ. Only on Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. Lots of federal employees are confused today about just what happens next after Elon Musk demanded they justify their positions in writing by midnight or risk losing their jobs. Many have been showing up at town halls across the country, like this one in Missouri, where they confronted their Republican representative, Mark Alford.
Elon Musk has contracts with the federal government. But he is also, I think, doing an effective job.
Correspondent Weijia Jiang is at the White House.
Hours before the midnight deadline, Musk posted, subject to the discretion of the president, they will be given another chance. Failure to respond a second time will result in termination. Then came further guidance from the Office of Personnel Management, saying agency heads may exclude personnel from this expectation at their discretion.
Defense Secretary Pete Hegseth is on his way to Guantanamo Bay, where President Trump wants to set up a 30,000-person migrant detention center. U.S. Southern Command says there are currently 17, what it calls, high-threat illegal aliens being held there. The Arizona legislature is set to vote on a bill to pay police a bounty of $2,500 for every undocumented person they help deport. State Senate Republican T.J. Shope.
This legislature is going to send some bills to the governor's desk that will test whether or not she's actually telling the truth about wanting to be tougher on illegal immigration.
Pope Francis still hospitalized in Rome in critical condition with double pneumonia. Still, the Vatican says he was well enough to hold a meeting on new saints. But doctors warn the 88-year-old's prognosis is guarded. Our chief medical correspondent, Dr. John LaPook.
With each episode, it's like a fighter who takes another punch and another punch and another punch. And after a while, it's hard to keep getting up from the mat.
Cautionary tale for humans worried they'll be swapped out for AI. CBS's Vicki Barker says a bank in Singapore has big plans.
DBS plans to cut 4,000 jobs currently filled by temporary or contract workers over the next 3 years, replacing them with artificial intelligence. It also plans to create around 1,000 new AI-related jobs.
Another restaurant chain is charging more for a pricey ingredient.
And stepping up to the plate, the return of Denny's original Grand Slam, and it's only $5.
Denny's says it'll add a surcharge to egg dishes. CBS's Nancy Chen.
The price hike won't necessarily hit every Denny's, but the restaurant declined to say which of the chain's 1,500 locations would see those surcharges. According to their website, the cost of a cooked egg, it starts at $2.99 right now.
The Dow is up 106 points right now. This is CBS News. The NFL may consider a ban on a controversial play.
All right, let's talk about the tush push.
Call it the tush push or the brotherly shove. Brotherly shove again. Hurts is in. Touchdown, Philadelphia. The Super Bowl champion Eagles have nearly perfected the short yardage play where teammates push quarterback Jalen Hurts from behind into the end zone or for a first down. The NFL says an unnamed team submitted a proposal to ban the play. Reports say it was the Green Bay Packers. Owners could vote on it as soon as next month. Buffalo coach Sean McDermott has suggested there could be safety concerns with the play, even though the Bills have used a version of it. Steve Kathan, CBS News.
More than 230,000 Canadians have signed a petition asking Prime Minister Trudeau to revoke Elon Musk's citizenship and passport. They cite him for joining, quote, a foreign government that's attempting to erase Canadian sovereignty. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube now, so head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. Coming up, we're going to check in with Tom Orlik, Bloomberg Economics chief economist, talking about President Trump seeks to toughen Biden's chip controls over China. Tom Orlik spent a lot of time living and working in Beijing. He knows China better than anybody. So whenever we have these China economic stories, we'll go right to Tom Orlik. Carol Schleif's going to join us as well. She's the chief investment officer at BMO Family Office. We'll get her thoughts on these markets. Ira Jersey, Bloomberg Intelligence soccer aficionado, but his day job is chief U.S. interest rate strategist. We'll get his thoughts on some of the economic data coming up this week, including PCE on Friday, and how that may impact the Fed. Sam Fazeli, he covers all the pharmaceutical stuff for Bloomberg Intelligence out of London. He's going to join us, give us the latest on global healthcare and what's happening in the world of big pharma and biotech. Let's kick this thing off, as we do every day, with Mr. John Tucker.
All right, guys, this report being brought to you by IBKR. Will the U.S. CPI exceed 2.4% in March of 2025? Trade your prediction with IBKR Forecast Trader. The yes was recently at 60%. Buy yes or no. Earn $1 if you're right. Go to ibkr.com/forecast. We are data dependent, so let's start with the data. The consumer confidence as measured by the Conference Board coming in less than expected, 98.3. We're looking for 102.5, and the prior reading was at 104.1. So consumers less confident. That matters because so much of the U.S. economy is powered by consumer spending. Also, yields right now, the 2-year, 7 basis points lower, 4.09%. The 10-year is down 10 basis points right now at 4.29. Money markets have been implying more easing from the Federal Reserve because of some of the weak data we've been getting. Meantime, the S&P 500, you have 7 of the 11 major industry groups. They are pushing lower right now. And also, we spoke earlier with Bank of America strategist Michael Hartnett. He says there are more doubts about the performance of the S&P 500.
Well, I think there's a little bit of suspicion about the S&P that's growing. I think Bitcoin has been a lead indicator for the retail element of, the stock market. If you look at the average price that people have bought Bitcoin since the last election.
All right, Bitcoin, let's pick it up there. Down 7.5%, 86,925. So that's dragging down with it some of the crypto-related stocks. Coinbase Global, for instance, that is down 7.8%. Ahead of its earnings after the close tomorrow, shares of NVIDIA among the most actively traded. They're down 2.3%. Home Depot says it expects consumers to think twice. They're going to think twice about large home products. The homeowners, they haven't been to my house. They say sales will be less than expected this year. So Home Depot, actually, it's higher right now, up close to 3%.
We're redoing our bathrooms at the Jersey Shore.
Oh, yeah?
Yeah. But I have people, John.
Oh, you have people. See, I'm on year 2 of my bathroom project.
I'm on year 1 still of a renovation project that was supposed to take a few months, but whatever.
You have people doing that for you.
I do have people, hopefully.
Anyway, S&P 500 down 36 points. NASDAQ 100 right now down 1%, a 231-point decline there. In the Dow right now down 51 points. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Alex.
All right. Thanks so much, JT. Alex Steele, Paul Sweeney, John Tucker. This is Bloomberg Intelligence Radio. I want to get back to this data because it is moving the bond market in particular. The 10-year yield's now down by a full 10 basis points, kind of encroaching on the 200-day moving average. All on that consumer confidence data, falling the most since August of 2021. Joining us now is Stephanie Guichard, a senior economist at the Conference Board. What led this decline in confidence?
So first, this decline of in confidence was broad-based across income and age groups, and it was really driven by a return to pessimism in terms of expectations for future business condition and future employment.
Stephanie, it seems like when we had the election, there was this burst of optimism across a number of fronts, including the economic front, that perhaps the Trump administration would be very pro-business, pro-growth, less regulation, lower taxes, all that kind of. The data kind of suggests that is fading a little bit. Is that how you interpret a data point like this?
So I think what you were mentioning before was reflected in our CEO confidence index that surged over the last quarter. So we published this last week. In terms of consumers, they are really focused on the short term, on what's happening right now to inflation, to the job market. We saw some increase in the price of some key staples for consumers, like the price of eggs. And this is really affecting their mood and how they think about the economy.
Is this data bifurcated in terms of party lines? Because what we typically see, say, in the UMich survey is that Republicans feeling good, Democrats feeling bad, particularly under President Trump.
Yeah, so that's still the case. I mean, Republicans are feeling much better than Democrats. But what we saw this month is a decline across the board. Strong decline for independent and Democrat consumers, and a slight decline also for Republicans.
Stephanie, thank you so much for joining us. Really appreciate it. Stephanie Guichard, senior economist for the Conference Board, joining us from New York via Zoom. One of the other big global economic issues out there for global trade is the U.S. relationship with China. It got tough under Trump's first administration. President Biden kind of keeping some of that rhetoric up as well. And now the second Trump administration trying to take up another level. So we want to get a sense of kind of where this may go. And there's no one better to speak to than Tom Orlik. He's the senior economist. I mean, he is the Bloomberg Economics chief economist. Lived and worked in Beijing for many years, so he really, really understands what's going on over there. Tom, give us a sense of kind of how you think the second Trump administration is going to approach China and maybe how China will react.
Well, it's great to be here, Paul. So I think it's interesting. I think there's going to be two rival groups who are kind of jockeying for position in terms of shaping Trump's second-term China policy. The first group, well, that's the China hawks. That's the folks who think China's catching up with the US way too fast. It's playing fast and loose with the rules on global trade, on intellectual property. And the US needs to take a really, really strict stand on this. And the second group, and you saw them on stage at the inauguration, well, that's the tech titans. It's folks like Tim Cook, who have the entire supply chain or a substantial part of their supply chain located in China. It's folks like NVIDIA, who have a huge part of their business depending on China's electronics supply chain. So, of course, that group would very much like to see something which looks more predictable, more stable, more open in terms of US-China relations. Early days, but we've got some reporting from Bloomberg News saying that Trump officials are speaking with the Netherlands and speaking with Japan about further toughening controls on China's access to semiconductors. So what that suggests is that the China hawks, at least for now, are trying to set the agenda.
So based on that, we're taking a look at the SOX index, the semi-index, down over 1.5%. So let's just go with the idea that we'll see stricter curbs on chips. Will it work? I mean, we saw what happened with DeepSeek, for example.
Yeah, it's a great point, Alex. I think if you were speaking with one of the folks that did the export controls in Biden's first term, they'd probably make a couple of points. So the first is that the first round of export controls, the Biden administration told everyone about it 6 months before it came into force, right? And that's a kind of fairly obvious misstep, right? If you tell China in 6 months' time you can't buy any advanced semiconductors, well, of course, China is going to spend 6 months assiduously stockpiling those advanced semiconductors. And then the second thing I think those China hawks would say would be, well, we always knew China was going to catch up pretty quick on the large language models. We knew they were only a few months behind ChatGPT, so DeepSeek wasn't a surprise. The export controls are really aimed at preventing China from taking that next step towards autonomous general intelligence.
Tom, based upon your experience in China, how do you think President Xi and the Chinese government will, I guess, respond and deal with this Trump administration? Did they understand how transactional President Trump can be, and therefore maybe there is a quote-unquote deal to be worked out to maybe just avert some of the bigger issues?
So we've had this news overnight from Bloomberg reporters on the Trump team speaking with their counterparts in the Netherlands and Tokyo. So clearly there's not nothing going on US-China policy. At the same time, if we think about where the major focus of attention for Trump has been in his first few weeks, well, it's been on Ukraine, it's been on Gaza and the Middle East. There have been tariffs on China, certainly, but there's also been tariff threats against Canada, tariff threats against Mexico. So China, relative to where I think we could have been, doesn't appear to be the kind of top of mind agenda item for the Trump administration. Now, I don't have, a hotline into China's leadership compound. I'm not privy to Xi Jinping's inner thoughts, but my guess would be that's kind of good news from their perspective, right? And they'd be pretty happy if Trump expends all of his energy focused on Ukraine and the Middle East and near neighbors, and perhaps doesn't spend so much time thinking about China and China's rise as a geopolitical challenger.
All right, Tom, always appreciate it. Thank you so much. Tom Orlik, Bloomberg Economics chief economist, joining us on potential chip controls over China and then the ramifications of that as well. I just want to update what we're seeing in the markets here. We are hitting the lows of the session, really rolling over after that U.S. consumer data fell the most since August of 2021. The chip index in particular is now down by 1.8%, a super strong bid, though, into the bond market in the back end. Down by about 10 basis points. We get a 5-year auction later today as well. All right, new for Bloomberg.com subscribers. Check this out. Get the Going Private newsletter. It's delivered to your inbox Wednesdays and Fridays, bringing you coverage of private markets and the forces moving capital away from the public eye. Subscribe to the Going Private newsletter now at Bloomberg.com/goingprivate. All right, yeah, good stuff, right? I mean, it's not in the public eye, so you kind of need it, right? Yep. Like it's kind of in the title.
Yep, I love it.
Coming up, Carol Schleif will be joining us, Chief Investment Officer at BMO Family Office. Her take on the downdraft today.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News with this Bloomberg Business Flash. And we are being brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. Offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. The softer economic data pushing Treasury yields lower. Major stock averages, they're also lower ahead of NVIDIA's earnings tomorrow. And the technology shares, the laggards right now. You have NVIDIA shares ahead of the earnings report after the close tomorrow. Right now, they are down 3.7%. The Conference Board's Consumer Confidence Index coming in lower than expected. Remember, it's the consumer that pretty much powers the U.S. economy. Traders now pricing in at least a couple of Fed rate cuts this year. The 2-year, 8 basis points lower, 4.08%. The 10-year, almost 11 basis points lower at 4.29. Eli Lilly, the index point leader in the S&P 500. Lilly ramping up the fight against cheaper copycat versions of Zepbound. Lilly shares right now up 2.3%. And Tesla, among the most active, it is down close to 7%. Their sales plunged 45% last month across Europe, where rival car makers, they saw a surge in electric vehicle demand. Right now, the S&P 500, 49 points lower, 59.34 the index. The Dow down 64 points. The NASDAQ 100 down 327 points. I'm seeing, it's anecdotal, but I'm seeing Tesla cars behind them. People are taking the nameplates off and covering up with something else. So
didn't Sheryl Crow get rid of her Tesla and then donate money to charity?
Yeah, I saw that on
something along those, or
the
I just
Elon
read a weird
maybe. But
rumor
that's
there.
what Tom was asking me when I got in this morning. Is Tesla going to make it? I was like, why are you even asking me?
Yeah.
I missed the Euro news. He was well read in on that. But I'm like, that's why Elon's trying to get everybody, and he has been for the last year or two, to pivot away from the focus on making cars, which is hard and expensive, to all the new stuff, the robo-taxi stuff, the AI stuff.
And the battery storage, which is huge for them. Also, there was a production issue in Europe, too. If you're not producing as much, you can't sell as much. So to look at that as well. Hello, I'm Alex Steele. Alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance. We're broadcasting to you live from our interactive broker studio right here in Midtown Manhattan. Just taking a look here at the markets, as John Tucker was just talking about, we're around the lows of the session. The NASDAQ is now up by almost full 2 percentage points. The S&P off by 1%. The semis are also getting hit quite hard, but really the rollover picked up a little bit of steam after that U.S. consumer confidence data fell the most since August of 2021. Carol Schleif is Chief Investment Officer at BMO Family Office and joins us now. Carol, I know you look longer term, but what do you make of the market action we've seen over the last 3 days? It feels like the buy the dip is sort of losing some steam here.
Well, maybe the buy the dip is, but it's important to remember too, we hit all-time highs a week ago. So, and markets have gone a very long period of time without the normal level of volatility that you'd see. You would expect a 5 to 10% kind of pullback in the normal range of things. We haven't really seen that. And so for markets to come a bit off that U.S. exceptionalism story and look at, there are a lot of moving parts going in the economy right now. But consumer confidence, business confidence, some of that stuff is starting to waver. We came off of the elections with a lot of exuberance in both places. And it's important to look at those numbers and realize that people are just kind of like it's been an awful big barrage of news in the last 45 days. And so taking a step back to take a breath and process some of that is pretty normal.
So, Carl, I know you folks over there at BMO Family Office take a longer-term view here. But putting in the context that we've had investors in 23 and 24 had really, really, really good equity returns north of 20%. How do you kind of reset here for 2025? What are the conversations you're having most often with your clients?
Well, I think a piece of it, too, is to realize that having ballast in the portfolio and having balanced portfolios didn't work in 22, but it definitely has worked some in 23 and 24. And so having some high quality fixed income in the portfolio, being willing to take some trims in there and sit in in cash that's yielding 4.5%, 5% is a pretty nice way to balance some of this off in the short run. Now, not trying to time it all the way in or all the way out, but there is an ability to be able to have some of that dry powder, if you will, on the sidelines. And we wouldn't be alone because clearly Warren Buffett has a lot of dry powder as well.
Oh, yeah. It was $11 billion in interest in money market funds.
Right.
330 some odd billion in cash sitting there.
Yeah, I'll take that. What we have seen,
Right.
though, is money kind of flows starting to move out of the U.S. and into Europe. Do you think that that actually is a trend that has legs?
Yeah, we do think that you've got that. You know, you've had a lot of conversation around Trump tariffs notwithstanding that there is an appreciation for Chairman Xi, for example, and there's a suspicion that all the tariff talk is because he wants to cut a deal there. So we do suspect that you've got a lot going on. And it's interesting because I saw some stats yesterday that talked about the performance in ETFs since Inauguration Day. And when you look at that, the US is flat, China's up close to 20%. And so you've got a lot of different interesting things going on there. And we have recently just actually taken a country position in China specific, as well as a Japan specific one that we've had on from a house view standpoint for a very long period of time.
Well, talk to us about that China call, because we just had a segment we were talking with Bloomberg economists just about the tariffs and the trade situation with China. So what is your view on China these days?
Well, I think another piece of it is when you look at the technology leadership that they've gotten, not just DeepSeek, but you go back to 2015 when they first initiated the China 2025 plan, industries they wanted to own, and the 10 years they've had to really focus on them. There's a lot of technological innovation and workaround, and the more we restrict advanced technology from them, the more they try to figure out how to make it work. And so between that and the beaten up valuations, not just in China, but in Southeast Asia in particular, there's a lot of interesting things going on there from trying to balance off the world. And it's always been a challenge. We've always led with, if you will, with globally diversified portfolios, but that's been a really hard argument to make in the last few years as the U.S. markets have so vastly outperformed so many others. But we think you're seeing a broadening out of that. So having balanced portfolios, and the key challenge is for long-term investors is never knowing exactly when those non-U.S. markets are going to move.
Interesting. All right, Carol, thank you so much for a few minutes of your time. We really appreciate it. Carol Schleif, she's the Chief Investment Officer, BMO Family Office here. Economic data moving the markets here today. Again, the consumer confidence data came in significantly weaker than expected, the weakest we've seen it since 2021. We're seeing movement in the financial markets, including the Treasury bond markets. Let's bring on Ira Jersey. He is the Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Ira, I'd love to get your thoughts on this consumer confidence number and the reaction we're seeing in your Treasury market.
Yeah, so the market was rallying even before that number, and the poor data or the weaker than expected data certainly had a little bit of an impetus to push us a little bit lower in yields, higher in price in terms of the Treasury market. I think what's fascinating about the move the last couple of days is really how we've went from pricing only one interest rate cut this year to two again. So I do think that there's growing pessimism in the market. I think you see that in some other ancillary assets, not so much in stocks, right? Like the equity market in aggregate has barely budged. But when you look at what's gone on in the crypto sector, for example, there seems to be at least a little bit of a burgeoning risk-off mood, and I think that that's feeding itself into treasuries.
How low can we go here on the 10-year?
Yeah, so we're targeting 4.13%, to be very precise. That's a pretty important technical level. That was the December market low. There might be some consolidation here for the near term because there's some momentum indicators like the relative strength index that are nearing typically overbought territory. But ultimately, I do think that there's the chance, and I've been saying this, basically for the better part of 3 or 4 months. I do think that we're broadly in a range. Largely speaking, call it 420 420 to 480, and can that go down to 4.13% and then back up to 4.5%? Yes, I think that's a very likely scenario in the back end of the curve. But a lot of this really does depend on what is the market pricing for rate cuts, and the fact that we're continuing to now price for a second rate cut, that's moved 10-year yields. Everyone's talking about things like term premium. That's not moving the market. In my opinion, the single thing that's moving the 10-year Treasury right now is expectations for rate cuts. And you look at the correlations there; they're like 98%. So the fact that you have overnight rates expectations moving so abruptly, that's moving the long end of the market as well.
Ira, we had a guest on earlier today, talked about a flattening yield curve, maybe even an inverted yield curve. Do you see that occurring? And if so, why would that happen?
Well, so the yield curve flattening a little bit, it would not be a massive surprise, particularly if the Federal Reserve were to cut 1 or 2 times and then stop and do nothing for, say, a year or two. That typically does get you to a flatter yield curve environment. To have an inverted curve, I think what you'd need to see is a particularly slowing economy with faster growth, so a stagflationary environment, because the Federal Reserve will be more reluctant to cut interest rates as inflation is above their target. But the long end of the curve would suggest that, hey, because growth is so bad and maybe inflation will come down eventually because of how bad growth is, that the Fed eventually will cut. So that would get you the inverted yield curve. I don't think that's going to happen. That's not my base case scenario by any stretch of the imagination. But it's certainly a risk case out there and not completely off the rails to think that another inverted yield curve could be possible.
So I feel like Friday, the story was about inflation is going to be stickier, it's going to be around for longer. And then I feel like somewhere along the last 72 hours, it moved more into a growth scare. Is that a good interpretation from me or no?
Well, I think it's both. I think both of those things are true, right? Things can be two things, as one of my favorite podcasts likes to say all the time. So one is that inflation, certainly the way that the market is pricing inflation expectations, it has been sticky. We're still looking at the next year having CPI near 3%, but today's move certainly suggests that the market is worried about a growth scare. So when you look at Treasury inflation protected securities, which tend to be most sensitive to growth scares, and then the policy rate that follows is that's where you're seeing most of the move. So inflation expectations have come down a hair today, but it's really the real yield that's come down quite a lot.
Tom Keene on the real yield quote. That's his jam there. So he
okay. All right.
In addition to the VIX. All right, Ira, thanks so much for joining us. Ira Jersey, Chief U.S. Interest Rate Strategist, Bloomberg Intelligence. He is badged in down there at the Princeton campus, which is a sight to behold. They've got a ton of EV chargers down there.
Yeah, do they still?
Yeah, like more. They add more and more all the time.
Well, isn't the administration looking to pare back any sort of federally funded charging stations?
I don't know.
Highways?
This is.
Wait, they get this for free?
Charging?
Princeton, yeah.
We've talked about this.
Yes.
Oh.
But now you want to go to Princeton, so you don't have to deal with the tolls.
Well, first I'd have to get an electric vehicle.
Yeah, but the Princeton.
So they're essentially getting free gas, basically.
And free breakfast and free lunch. I'm telling you, folks in Princeton, they got it wired in.
To be fair, we also get free breakfast and free lunch. Just put it out there.
Snacks.
Sometimes they have croissants.
Lunch.
All right,
I want
okay.
free fuel for my car.
All right, S&P
Throw the lunch in
500.
there.
We are selling off here, down 1%. The NASDAQ off 1.6%. We'll have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. It's the technology shares of laggards right now as the major stock averages adding to their declines. The Dow, though, it's pairing some of the earlier losses. Ahead of its earnings after the close of regular trading tomorrow, NVIDIA, the most active, and shares of NVIDIA right now down just about 3%. The Philadelphia Semiconductor Index, the SOX, down 2%. Betting has increased. The Fed's going to cut at least twice this year after softer than expected economic data. You had at the top of the hour the Conference Board's Consumer Confidence Index falling more than expected. And Rebecca Patterson, formerly of Bridgewater Associates, says there are plenty of signs the economy may be faltering.
Confidence is where we're seeing some question marks. The other piece that's changing is economic surprises. A lot of economists revised up their expectations immediately after the election. What we've seen over the last several weeks now is data coming in below expectations.
Right now, Bitcoin down 8%, so it's 86,800, whatever. With Bitcoin plunging, crypto-related stocks are falling. You have Coinbase Global. Right now, those shares are down 7.6%. Overall, the S&P 500, 54 points lower. That's down 0.9%. The NASDAQ 100 right now, 333 points lower, and that is down 1.5%. Two-year yield, 9 basis points lower. That's a move, 4.07%. The 10-year, 11 basis points lower, and that is at 428. We check the markets view all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
Yeah, we have a proper sort of thrown in some towel here stuff. We have a classic rush to safety. We have a de-risking sort of scenario. Yep. Interesting how this shapes up. The SOX index, semi-index coming down as well. NVIDIA off by over 3%. One story on the terminal that caught everyone's eye is that NVIDIA and Cisco are actually extending a partnership hoping to speed up AI adoption. So we wanted to get more of a view on what that meant with Woo Jin Ho, Bloomberg Intelligence Senior Technology Analyst, joining us on this. Okay, first off, just break it down for us. Cisco has the guts, NVIDIA has the chips?
No. Hey, Alex, it's actually the other way around. Cisco is offering their chip, and NVIDIA has the box. So it's actually an interesting twist because Cisco is usually the box maker. But one of the biggest, one data point that a lot of people don't know about Cisco is that Cisco is actually one of the largest chip manufacturers globally, given that they are the leading networking manufacturer, and they manufacture their own chips. So they've actually done a good job with this deal with NVIDIA, I thought.
And I know one of the goals here, Woo, is kind of push AI from maybe just some of the larger companies into maybe small, mid-sized and smaller companies. Is this tie-up going to kind of achieve that, do you think?
Yeah, I think NVIDIA is looking for ways to bring their networking gear more towards the enterprise side. I can't think of a better way for NVIDIA to get into the enterprise on the networking side at the very least is to tie up with Cisco, primarily because they're the leading switching provider on the enterprise side. Now, what makes it interesting, though, is what does it mean for Cisco's boxes, right? Because I'm sure they want to sell their own boxes to the enterprise to help support AI workloads.
Well, that's what I was wondering. So, okay, then aren't they cannibalizing their own business longer term?
Potentially. I mean, we'll see. We'll see how that plays out. We have to keep in mind that this is part of a multi-year agreement. There is a server agreement with NVIDIA to use NVIDIA GPUs as part of Cisco's servers. Cisco has actually underwhelmed on the server side for now, and maybe there is a course of action for both companies to better penetrate multiple business lines with the partnership.
Wooj, we're going to hear from NVIDIA tomorrow evening with their earnings, and obviously everybody will be paying attention there. And I guess one of the questions is just kind of where are we in terms of the velocity of spending here on AI? Has it slowed? Will it slow? Or are we in a new period of perhaps lower growth? From your perspective, what's your view?
Did you just use the word velocity on air without Tom Keene in the room?
I did.
Wow. Okay.
Sorry, go ahead. I used quiescent once as well.
That's amazing. Okay.
Yeah, and that's a great question, Paul. Now, the one thing is I think that the velocity near term is going to be still fairly robust. What's coming to some doubt is the long-term velocity and the sustainability of the growth and the ramp-up for AI. I mean, you know, the TD report from yesterday with regards to Microsoft paring back on their data center leasing, that kind of seems to have spooked the markets. If I look at my AI networking stocks, they're paring back because some of the long-term growth hopes are kind of being, you know, pulled back a little bit, which is driving down some of these multiples.
Let me switch gears here and talk about Supermicro for a moment, because today's the day, right?
I forgot about that.
Yeah, right?
Today-
Like they have to
today is the
submit
day.
all the paperwork to the NASDAQ to become compliant with their listing rules by the end of today. So TBD what happens to Supermicro tomorrow. What do you think is how this is going to play out?
Well, all right, so a couple of clients pinged me this morning. What time today do they have to file their 10K and 10Q?
12:59 p.m.
No, it's actually 5:30 p.m. today, right? So if it needs to be submitted to Edgar by 5:30 p.m., if not, it will be considered tomorrow's filing. So we'll see. Hopefully by the close, they'll have the filing in. You know, based on the last earnings report, the sense I was getting was that they should have all their ducks in a row to get not only the 10K but also their prior 10Q and also the current 10Q submitted by now. You know, you're starting to see the stock pull back to de-risk of a miss. Now, there's a couple of things that can happen, right? They can actually file for another extension. They'll be or they could be delisted and go on the pink sheets, right? And I mean, those are the two things that can happen, and or they file. So if they file for another extension, I think the company should be okay. If there will be doubt, if they file, the company should be okay, if not better. And if they get delisted, you know, there's another, you know, snowball effect because they can get pulled back off the S&P 500 index.
So, I mean, this is a crazy story here because Supermicro Computer, for those who don't know, this is a real hardware company. It's $27 billion in market cap. Stock's down 9% today, but it's up 53% this year, but it's down 45% over the trailing 12 months. So the market has no idea what's going to happen here. Can you explain to me how a real company like this can get into a position where they can't file their financial documents on time?
Well, there's been a track record with Supermicro where they haven't been able to file. Keep in mind, this was a $3 billion in sales company just 3-4 years back, and they probably didn't have the you know, the financial organization to support a $25 to $30 billion company. So they were probably running loose with their accounting. We had the Hindenburg report come out last August, and you know, alleging fraud, and we had an auditor depart from them. So that actually heightened some of those concerns. They do have a new auditor, and the hope is that if they file, everything should be hunky-dory and back to business as usual. We'll see.
In my 35 years, I have never seen a situation like this, and I've taken little dinky radio and TV and outdoor companies public. We always got our numbers in on time.
Well, especially because this is a company that makes money and stuff, right?
Yes.
Like,
I just, you know, I can see some of these startup companies or some of these, you know, little companies don't have the resources, but holy cow. All right, Woods, be on guard. Alex may want to talk to you this afternoon for Bloomberg Television as this thing
Truth, don't go
breaks
far.
one way or the other.
I'm around for you guys.
All right, Woo Jin Ho, he covers all the tech hardware and networking stuff for Bloomberg Intelligence. We got a global team that covers global technology, and Wooja does the hardware and all the networking stuff there. So staying on top of that, but that's just an amazing story. Super microcomputer. But again, the story for tech and arguably for risk appetite for this market might be tomorrow afternoon with the NVIDIA results. A lot of folks are saying it's going to be a clearing event. I stole that from Jim Cramer. A clearing event one way or the other. Good numbers, animal spirits, you know, reawakened. Bad numbers, oh boy.
I mean, sure. I feel like we say this every quarter with NVIDIA. So, I mean, fair enough on that point. All right, coming up, Sam Fazeli on eggs. Basically, no one better on the pharmaceutical industry. He'll be joining us on the bird flu outbreak and just in general, the state of global healthcare. This is Bloomberg.
Listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Alex Steele, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio in New York City. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast Now, and that's where you'll find us. Lots of news flow out there. We know that over the last 45 days, and that includes in the areas of healthcare as well. There's flu cases out there. There's measles. We've got a new head of the, HHS and RFK Jr. A lot going on out there. Sam Fazeli joins us. He'll kind of put everything into focus a little bit here. Sam Fazeli is the Director of Research for Global Industries, and he's the Senior Pharmaceuticals Analyst for Bloomberg Intelligence. He's based in London. Hey, Sam, let's just step back, and we've got RFK Jr. leading the, what's HHS? Health and Human Services?
Yes.
I mean, that's a big gig. How does the healthcare industry view this change in leadership and maybe a really different change in viewpoint going forward?
Yeah, I think, Paul, and hello to everybody. The healthcare industry has been relatively silent with regards to this. There's physicians out there who have been a lot more vocal, etc. Paul Offit being one of them, who's actually a member of one of the vaccine advisory committees. But the industry has been relatively quiet. I think they're just trying to figure their way through how they manage this change. And, we had RFK Jr. deliver his welcome remarks to the HHS staff almost exactly a week ago on the 18th of February. And a lot of great things were said. Unfortunately, a lot of awful things were highlighted. sickest nation on earth. 6 out of 10 adults have at least one chronic disease. Highest age standardized cancer rates. Asthma, autoimmune, far more common than any other country, et cetera, et cetera, et cetera. So these are things that he is aiming to change or to affect the change in. Now, will he be able to do that or not is going to be interesting, but there are some other aspects of what he's been talking about which are not particularly positive.
Like?
Well, so if you think about the 3 things that he said he wanted to address in order, lots of things that he wanted to address, but in order was childhood vaccination schedules, linking back to, although he didn't do it, he's worried about the cases of autism rising in children. So therefore that creates a situation as to, which we'll come to measles in a minute, where you wonder, are these comments going to help people think about taking a vaccine and giving their kids a vaccine or not? Well, I wager they're not. Electromagnetic radiation and glyphosate. Now, all of these things have been considered heavily in the science world and been dismissed as issues to worry about. So he's raised them again. Are we going to spend a lot of money doing these studies where most people believe that the science is already solid and saying that there's no link? That's one of the worries that we have. Obviously, there's lots of other things he's been touching on. So, and measles is as you've been hearing in the news, is back in the news again, which is a bit worrying, right?
So, what is the state of the measles situation here in the U.S., Sam? Is this something that people should be concerned about?
Yeah, I mean, look, Paul, this is one of the most infectious agents around, such that it's interesting that the CDC, still on their website, so obviously CDC is now under HHS, says highly contagious. It can survive in the air in a room for up to 2 hours. You walk in, someone's been in there with measles. 9 out of 10 people who are susceptible will get the virus if exposed, right? According to the CDC. So there used to be 3 to 4 million cases before the introduction of vaccination in 1963, and now we're down to 200. We can't. That didn't happen by accident, right? So what I think we need to worry about is if comments about vaccination in children take hold among people, then you might see this issue that's going on. And in Texas, where we're looking at, there's nearly 14% of K2 children in the 23-24 school year that haven't been vaccinated. And guess where the issue with measles currently is? Nearly 100 cases, Texas. So that's one of the things that is worrying and we need to keep an eye on.
Yeah, absolutely. I did hear, though, that you don't want to talk about birds, which is a bummer. So no bird flu thoughts? Because I got to tell you guys, my husband finally on Saturday was like, what? $12 for eggs? Yeah. So we're at that point in the Steele household.
Yeah, it's so sadly, Alex, these things tend to take a while to hit normal people. God willing, not because of the virus, but because of side effects. So pretty much a lot of chickens have been culled in the US because of this issue. Now, there are a couple of things that worry me about it. One is that it's rampant in farms, some farms, not every farm, in terms of cattle. Second thing is that people have found it in cats, domestic cats. Well, guess who lives with domestic cats? People, right? And rats. Guess where there's rats? Everywhere. Right.
We know. We're in New York.
Right. So the issue is, this is the sort of thing that you just want to close your eyes and hope that nothing actually untoward happens. The more the virus, we've talked about this over the past few years, the more of the virus has an opportunity to infect whatever, the opportunity for it to get to humans and, God forbid, start transmitting. That's the bit that it hasn't done yet, transmit from human to human.
Sam, the flu has been really bad in the U.S. this flu season.
Oh, my God, it was so awful.
How about the U.K. and Europe? Has it been similar or no?
It's pretty much, it's very difficult to walk around the office here and not find somebody who's got some flu. I've got my son-in-law who's in a hospital in San Francisco with flu. Hospital, right? Now, God willing, he's recovering. The thing is that my colleague Glenn Losef just wrote just about a week ago about the fact that the US is at a 15-year high in terms of flu cases. And what I'm trying to do is get my head around why, right? And I don't think it's vaccinations. And the interesting thing is, here's what we've been looking for.
Yeah.
Flu is much more rampant than COVID.
All right.
Yes.
Yep, I know.
Oh, all right, Sam. Always a bearer of good news. Sam Fazeli, Bloomberg Intelligence, Director of Research for Global Industries and Senior Pharmaceutical Analyst. All right, for our listeners in the U.S., here's a reminder. You can listen to us via satellite radio on SiriusXM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on SiriusXM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The second hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Tuesday, everybody. Alex Steele here alongside Paul Sweeney. This is the second hour of Bloomberg Intelligence Radio. We have a great lineup for you. We are definitely seeing a de-risking day take effect in the market, whether you're looking at commodities, Bitcoin, or the equity market. You're also seeing a strong bid into the bond market as well. Mike McGlone will be joining us, Bloomberg Intelligence Senior Commodity Strategist, on that Bitcoin tumbling now. Drew Redding will be joining us. He'll discuss Home Depot. He's also from Bloomberg Intelligence. Those numbers disappointing the street just a touch. And Kim Forrest, always one of our favorites, will break down what to make of these markets. She is head over at Boca Capital Partners. And then our own Michael McKee will be joining us to break down the economic data. Remember, it was that consumer confidence at the top of the last hour that led to this next leg lower in the equity market. So we'll break all of that down for you. But let's kick it all off with a Bloomberg Business Flash with John Tucker.
All right, right now the major averages, they are all lower. The Dow kind of hanging in there. It's been bouncing between gains and losses. But that's largely because of Eli Lilly, Home Depot, and Walmart shares. They are higher right now. And it is the technology shares that are leading the declines. This comes in advance of earnings from NVIDIA. We're going to get those results after the close of regular trading tomorrow. It's the most actively traded stock right now. Shares of NVIDIA down 3.25%. Restrictions on selling to China, that could be a cloud over the company. At least that's according to Dan Ives at Wedbush Securities.
I think some of this stuff does go to the background, but no doubt it has been white knuckles to start the year. You know, just given you don't know what's going to come out from a regulatory perspective in terms of this U.S.-China cold tech war.
Right now, the S&P 500, 55 points lower. That is down 0.9%. The Dow lower right now, down 53 points, and the NASDAQ 100, 335 points lower. The declines there continue, down 1.6%. I want to say the real action actually has been in treasuries. Yields pushing lower after the latest economic data. The consumer confidence is measured by the Conference Board falling more than expected. So right now you have the twos down 8 basis points, 4.08%. The 10-year, 10 basis points lower, 4.29. And oh yeah, also one of the most active, Tesla. Tesla's market cap has now fallen below $1 trillion. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right, JT, thank you so much. We appreciate that. Alex Steele and Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio in New York City. It's getting warmer out there, kids. We're streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast Live. As John Tucker was just reporting, a sell-off in the market, some economic data moving the market here, and that's before we're going to get a big NVIDIA print tomorrow after the close. Let's see where the action is under the hood. Isabel Lee joins us, cross-asset reporter for Bloomberg News. Isabel, what are you looking at?
Definitely the Magnificent Seven. They're plunging in correction territory after hitting their high in around December. That's erasing $1.4 trillion in market value. So we have the Bloomberg Magnificent Seven index. That's an equal weighted gauge that tracks all the Magnificent Seven. It fell around 10%. So that's really an interesting thing to look at, especially since, to your point, we have NVIDIA earnings tomorrow. And we know that NVIDIA's direction of travel typically influences the market. And it comes at a time when U.S. stocks are really just vulnerable for any technical and systemic corrections. Options markets approaching NVIDIA's release are also less bullish. So there is that.
Well, yes, and also interesting, too, when we had the continued chip news out of D.C., like that overhang. This is also the first result since DeepSeek, so that's going to be really interesting. It's going to be a lot of fun stuff happening there. All right, let's go to Home Depot. We're going to talk to an analyst in just a moment, but just give us the headlines here.
This is a little bit of good news, up around 4%. They said that sales will rise less than expected this year, but the firm is anticipating that consumers will remain largely cautious. So comparable sales will turn positive in January 2026, and I think that's really what's buoying sentiment. Bloomberg Intelligence says full guidance is appropriately conservative. And it's just interesting to see Home Depot because it was the biggest winners during the pandemic, but people have stopped decorating their homes.
Well, let's go to John Tucker, our do-it-yourself correspondent.
Okay, here's my cure.
You didn't even have to set him up.
For Home Depot, we'll just sell 2x4s that are straight.
Really?
You go in there and you have to pick through the pile. It looks like spaghetti.
Where do you get your stuff now? You get it at a special place.
I get it at a lumber yard.
He's got a guy.
Yeah, he's got a guy.
Expensive, but the stuff people have got to understand. It's the time. Time is money. If you're working with a bent 2x4 that costs less,
that's not going to work.
Save you any money. But anyway,
Isabel?
I digress.
It's stuff you learn in the studio.
That's a flex, though, because that means you have space. I just have a tiny little apartment.
Well, it's time you upgrade.
Yeah, exactly. All right, 30 seconds on Supermicro.
Supermicro is interesting. It's down 8.5%. So today is the deadline for them to submit all outstanding financial reports to bring it back to compliance, basically for it to still keep on being listed in the NASDAQ 100. And let's just say, if it gets booted out in the NASDAQ 100, it's also in the S&P 500. So that also remains into question. Our team covers index rebalancing. So it's really interesting to see whether it will still be there. But shares are now down 8.5%.
All right, Isabel Lee, thank you so much. We appreciate that. Isabel Lee, cross-asset reporter, Bloomberg News here. Bitcoin off 7.7%, 86,700 bucks. What is going on there? Let's go down to sunny Miami Beach, Florida, 75 and sunny, folks. That's where our good friend Mike McGlone, all the smart people are down there now. Mike McGlone, senior commodity strategist for Bloomberg Intelligence. Mike, Bitcoin, Tom Keen's asking from the Upper East Side, what's going on?
The classic example, Paul, of you're supposed to be selling when they're yelling, and that rally we had up to 100,000. I mean, it was as bad as 1999. Those of us who remembered Pets.com and that stuff like that. And so there might be a lot of smart people down here, but one thing about people get very emotional about markets, and the key thing I have a problem with Bitcoin, it reached a great milestone at 100,000. You're supposed to be taking profits. Not everybody did. A lot of people got too enthusiastic. But the key problem is in the whole space, there's a massive excess of supply. On CoinMarketCap.com now, there's about 12 million cryptocurrencies listed. That's in millions. When I first started writing about it in like 2017 or so, it was a couple thousand. So that's the key thing now. We have one crypto, Bitcoin, and then we have 12 million wannabes, massive supply, excess speculation. And I think it's also the leading indicator, as you pointed out earlier, it's leading everything lower.
So, here's my fun question that I asked Ira Jersey. How low do we go here?
Yes, I think the key level to look for is around 70,000 for support. That would be normal. That's basically about where it was before it broke out higher. I mean, it's not much further when it's where it is now. When I said that a few months ago, people were not too happy. That's the key thing about being a bear in a bear market. No one loves you. But I'm just pointing out facts. The key. So I don't know. The key thing at this point is I don't know what stops it. And the bottom line, I like to say, is cryptos will be okay as long as the stock market goes up. And that's the key problem. What you're looking at, I think, in Bitcoin and all these cryptos is leveraged beta. I mean, Bitcoin trades 3 times the volatility of gold in the S&P 500, and they're all heading lower. It's just Bitcoin's a leading indicator, and it's the most speculative and excessive, and it has unlimited supply in that whole space.
Gold off 1.9% today. Mike, is that just a market move?
Yeah, it's a margin call thing. We saw that in 2008. Gold has massive longs and futures. I mean, people are riding that rally. It's off short term. But I think gold's bumping up the good resistance around 3,000. I'm glad you mentioned. If you look at that Bitcoin to gold ratio, it's plunging, which means gold's outperforming. I think that's going to be by the end of this year. We'll see that gold's going to really beat the Bitcoin, partly because if Gina Adams is right and the stock market continues to decline, gold should be the beneficiary. But also you mentioned the thing about gold, I want to point out, it's the most expensive ever on a 35-year basis versus the Bloomberg 20-plus Treasury bond index. So Treasury bonds are really cheap versus gold.
So it's totally fair, and you look at indications and it might say the same thing. Why wouldn't Bitcoin be a good diversifier along with gold? That's what really perplexes me about that asset class, because At sometimes it's safe haven, at sometimes it's a risk on, risk off, and it's really hard to gauge what is going to move it when, on what day.
Because Bitcoin has a much higher correlation to the stock market and other cryptocurrencies than it does to gold. And the key thing about gold's correlation to the stock market over time is basically zero. And obviously when stocks go down hard, it goes down with it. But it's that key correlation. The key thing I want to point out is you look at things like Shiba Inu and Ethereum and Dogecoin. Bitcoin has a much higher correlation to those other cryptos than it does to gold, and has a very high correlation to the stock market.
WTI crude oil, we're now solidly below 70 at $68.90. Just a commodity sell-off here. Is there anything particularly going on with WTI crude?
You don't want to fade Trump. He's got supply. He's got supply and demand in his favor. He wants prices to go lower, and the trend is already heading lower. And the key thing I want to point about crude oil is excess supply in the U.S. and OPEC and declining demand from China. I mean, what's good about for prices for that? The bottom line for crude oil is it probably has to get cheap around $56 a barrel, which is the break-even cost in the U.S., which is normal, what it usually does. And then it might have a little bit of a recovery. But for right now, it's heading down. Copper looks like it's peaked. Crude oil looks like it's peaked. Corn looks like it's peaked. Natural gas is bumping up. It's all commodities are just having that problem of elasticity of supply.
And just to point out, too, just to add, it's no but this time. This is an and. Iraq is going to see some flows of almost 200,000 barrels of oil a day from Kazakhstan. That's been shut for 2 years. So at just the wrong time, you're getting that supply come on, and that's really denting any bullish enthusiasm you might have seen with more Iranian sanctions. Look at me, Mike. I'm adding a and to your statement. Okay, before we let you go, what's up with my coffee?
Oh, okay. Well, that's going to be more of a supply elasticity thing, and we'll bring on supply. It just takes a little longer. It's just not a major commodity, so it's just how much longer it's going to stay up the side. The key thing about coffee and cocoa, they're sown in that equator area. So if that weather trickles down to the Corn Belt, that's a problem. But overall, like the Corn Belt, Brazil, soybeans, and everything, the supply is pretty good. For overall, it's a bit of an outlier in terms of more normal commodities. The key thing is commodities pumped up way too much in 2022 overall, and now they're still heading lower because of those elasticity forces.
There you go. We'll do pork bellies next time, Mike. Mike McGlone, senior commodity strategist, Bloomberg Intelligence. He was one of the first people pandemic to go down to Miami when the you-know-what hit the fan. So, and he ain't coming back, folks. That's all there is to it.
It's not happening.
That's where we go. Let's go to Home Depot. I'm looking at the stock here. The stock's up 3.5% here. So some numbers came out today. Tepid kind of numbers, but again, stock traded off a little bit. Now it's higher. Let's get the latest. We go to Drew Redding, Bloomberg Intelligence, U.S. home building analyst. Drew, talk to us about Home Depot. What did you see in their earnings release and in their conference call?
Yeah, it was a good quarter for them. Comp sales were positive for the first time in 8 quarters. So I think that's something a lot of people are latching on to and a positive indicator moving forward. You know, we came into the quarter thinking that they could do a little bit better than consensus on the comp line, really because of some of the positive data we've been seeing coming through in retail sales, along with the expectation that some of the recent hurricane activity would benefit them. And that's something they called out. They had about a $200 million benefit from hurricanes, which is about a 65 basis point lift to comp sales. The guidance was pretty positive. They're looking for about 1% growth next year, which we think is appropriately conservative. And it's pretty much in line with what we've heard from some other players in the home improvement space who are looking for the market to be flat to modestly higher next year. And there's really no incentive for them to come out and be overly optimistic for next year, given the struggles we're still seeing with housing.
I was struck by the fact they said they are seeing more refis. Does that mean that people are going to refi to then spruce up their house?
Yeah, I mean, in order for this industry to see more normalized growth going forward, that's something you're certainly going to need to see is people tapping that home equity, undertaking larger scale renovations. It's still one of the areas that's kind of holding back growth. They cite it, kitchens and baths as a particular area of weakness. And the reason is because those projects are typically financed. So while they did mention that they saw a little bit of improvement, it's still nowhere near, what the industry would need to see in order to get more robust growth going forward.
Hey, Drew, it may shock you to learn that I spend very little time in either Home Depot or a Lowe's. So how does the street differentiate between the two? Because I'm looking at the stocks over the last 5 years. They're both up, 11, 12, 13% on a compounded basis. Do the same shareholders own HD? Do they own Lowe's as well? How do you differentiate?
Yeah, so the main point of differentiation between the two is really their customer exposure. You remember Home Depot is about 50% DIY, 50% professional contractor, whereas Lowe's is about 70% DIY, 30% pro customer. As we look forward, we think that the primary engine of growth for the industry is going to be from professional contractors. As you start to look out ahead and you do see people tap that home equity, we think that's where a lot of the growth is going to come from. For Lowe's, as I mentioned, they've really been focused on DIY, but over the last couple of years, they're starting to transform their business to cater more towards that professional contractor, because I think they realize that's where the growth opportunity is. Now, for Home Depot specifically, their strategy is to go after an untapped $200 billion market for more complex pros, which are those looking at, larger scale remodeling projects that span a lot of product categories. And they want to consolidate those contractor vendor relationships so they could become the one-stop shop.
So here's John Tucker's complaint, is that the 2x4s at Home Depot are warped.
Can you fix that?
And that, but like, I'm joking, but the idea is that this is a guy that does a lot of work, and Home Depot could make a lot of money off of John Tucker on a relative basis.
Well, let's not get crazy.
And he goes to the local lumber yard. I mean, can they sort of expand their base?
Yeah, so Home Depot does pretty well with lumber. It's about 8% of their sales. But to your point, I think they are expanding their reach among those professional contractors. They recently did their largest acquisition ever for SRS Distribution, who is primarily in the roofing, landscaping, and pool supplies categories. But I think what that does is it shows you that they're willing to go into these new markets to reach these new growth avenues. And I think that the SRS deal really provides a platform for them to continue to go after these different type of building product suppliers. SRS has been highly acquisitive, and they even called out on an organic basis. They're looking for mid-single-digit growth next year. So I think it provides a strong platform to do exactly what you mentioned.
So if lumber is such a big part of these businesses, I'll take your word for it. What are they saying about tariffs? If I would guess they get a lot of their lumber from, I don't know, Canada.
Yeah, so surprisingly, it wasn't really an emphasis of the call. Home Depot and Lowe's are among the largest importers of goods, as you would expect. But over the last several years, I mean, the point is really that since the last time this administration put larger tariffs into place, they've really diversified their supply chains out of some of the markets that are most dependent, like a China. Now, a majority of their products, their cost of goods, is still sourced domestically, but they certainly do have exposure to China and some other markets, and we would expect to see somewhat of a margin impact, as these tariffs continue to go through.
All right. Great stuff, Drew. Always good to catch up with you, Drew Redding, Bloomberg Intelligence, joining us. He's a home building analyst there discussing Home Depot earnings.
Really densely packed rings in your 2x4s.
How do you know if
Douglas fir?
Can you
can
see
look
them?
at the end of it. Yeah.
Okay. All right. Because if you don't get that, what happens?
Well, it's just a higher quality lumber. You will pay more for it, but like I said,
But it won't warp. Because apparently our roof in the country was starting to be a dome. Rather than like
Really?
actual straight, good times, hence the bill that I keep getting. All right, coming up, Kim Forrest, founder and CIO of Boca Capital Partners, will join us on her outlook on the market. Plus, Michael McKee will break down the economic data, that consumer confidence data that came out at 10 o'clock, really kind of weighing on the market. We will break that down as well. Apparently, it was a broad weakness in confidence. We'll get that for you. This is Bloomberg Intelligence. Happy Tuesday.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And this Bloomberg Business Flash being brought to you by Oracle. Attention growing businesses, Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. Offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. Let me start with treasuries. Yields are lower because the economic data is softer. The Conference Board reports its Consumer Confidence Index posted the largest drop in more than 3 years. 2-year Treasury yield is now down 8 basis points, 4.09%. The 10-year yield is down close to 10 basis points, and that is at 4.30. Bloomberg Economics attributes this sharp drop in household confidence to White House policies. Their opinion. NVIDIA, most active stock, it is down right now about 2.6%. So apparent some of the earlier losses, and of course this comes ahead of its earnings tomorrow. It's among the big cap tech stocks dragging on the markets today. Here's one for you. The National Restaurant Association urging President Trump to exempt food and drinks from tariffs. They estimate the levies will cost their industry over $12 billion and lead to higher prices for consumers. S&P 500, 55 points lower. That is down 0.9%. We're at 59.27 on the index. Dow Jones Industrial Average, as I said, that's been bouncing between gains and losses. Right now, 36 points lower. The NASDAQ 100 down 348 points. That is a decline of 1.6%. And just getting this word from the Associated Press, 21 civil service employees have resigned from Elon Musk's Doge. They refuse to, and this is in quotes, dismantle critical public services. So getting a little pushback there. And we check the markets for you and other news all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
All right, JT, thank you so much. We appreciate that. Alex Steele and Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City. We're also streaming live on YouTube. So you can head over to youtube.com and search Bloomberg Podcast Live, and that's where you'll find us. Well, after the close tomorrow, NVIDIA reports, and that is always a big day for NVIDIA shareholders. I think for technology shareholders as well, and as the markets overall. Really, for the last couple of years, NVIDIA has been a market-moving event, so we want to get a little bit of a preview there. And then we're also going to talk hamburgers. How we make the connection there, I don't know, but we'll try to do it.
I like it.
Kim Forrest, founder and chief investment officer of Bokeh Capital Partners in Pittsburgh. So, Kim, I'd love to just take advantage of your technology chops. What should we be looking for when NVIDIA reports tomorrow?
Sure. Well, I'll say what I say for absolutely every company. Who really cares what happened last quarter? I want to know what's going to happen next quarter and the quarter after that. And I think never has this been more important than for a company like NVIDIA, who is at the forefront of a very new technology that, you know, literally hundreds of billions of dollars are being thrown at. So the question that we have is this: is it for real? Are people still going to pay up? Are they still going to build these huge data centers to run something that we don't have a problem that we can identify that the money is fixing? That is the question.
And what do you think that's going to be? Best guess.
Yes. I mean, well, for a couple of reasons. Firstly, I'm a nerd. I'm a proud nerd.
No, we feel you.
I was a software engineer in AI doing stuff with neural networks. How lucky are we that this all has come up and I know about it? Okay, but anyhow, here's the problem. The only thing that I can see that large language models really solve is the ability to get information in and out from humans to computers a little bit better. And who's going to benefit? I say right now, it looks like search, that people are using it to search. They love it. And all these other kind of higher order, smarter things, we're not really able to pull off, take care of my travel to go to Sydney, Australia, right? And here are the dates, and get me the cheapest, fastest airline there. It can't do that. Not yet. Maybe not ever. We don't know. Who cares? But right now, I think the companies that are putting money into this are those that have some sort of search that they're trying to maintain their market share. So Google, I'm talking to you, and to a certain extent, Meta, right? And Microsoft is the third one. So those people are going to continue, or those companies are going to continue to pour money into this area for the foreseeable future.
All right, here's the hard pivot from AI to hamburgers. And here's my take on the hamburger business. Wendy's, I will stack up a good old Wendy's burger against a lot of the new ones out there, whether it's the Shake Shack, the Five Guys, all that kind of stuff. The Wendy's burger hangs in there. How about the stock here? Kim, what do you guys think about Wendy's here?
It has not been hanging in. That's the first thing, right? New is always better. People go, hey, let me try that Shake Shack. And then they're going to drop a lot of money and go, well, that was an okay burger, but okay, next time, maybe I want to do something different. That's one of our theories, is the growth of Shake Shack is going to reintroduce people to a good hamburger. Like McDonald's has its own flavor profile. It's not like a regular hamburger that you'd make at home. And I guess Wendy's isn't either because it's square, but we move on from that, right? Anyhow, back to it. No, the company's been trying to grow in breakfast, and that has impacted its earnings. And we're looking past that saying, hey, they've got a good idea. They're mostly a franchisee chain. The company owns, some of the restaurants. This is a good model. And, we're hanging in there thinking they have a pretty good product, and it might be time to look at it because it's sold off recently.
So how do you pick between all the fast food guys? It's sort of like, can you own a lot of them at this point when you have exposure to inflation, when you have exposure to the consumer?
Well, I kind of go on my own, right? Because I'm a consumer and I'm kind of a picky, I like really high quality stuff, but I don't want to pay a lot for it. And Wendy's kind of fits that profile in many ways. First of all, they skew to a higher income buyer than a lot of the other chains. So that's something that I like. And I also like that in any sort of consumer-oriented pick, because I think there was news out yesterday, maybe by Bloomberg, that the top 10% is spending more than they ever have. And they spend on things like hamburgers, right? So we like that. We like their salads. In the summertime, they get a lot of traffic away from Panera, again, because it's a value option and it's convenient. So that's kind of my view. I don't want to own the whole lot of them. I want to own companies that are poised to beat the competition.
How about on the cost side, the cost of beef? I know that's been an issue for everybody.
Cost of beef is, and here's the problem, they're fresh, not frozen, so they're buying from America. They don't really have the luxury that a lot of the other burger chains who are buying from South America and Australia. So that is an issue, and that's something that we're all going to have to suffer through for a little while here. But hey, I hear there are these things called tariffs. I don't know.
Yes. Truth. Hey, Kim, always good to catch up. Appreciate you, Kim Forrest over at Boca Capital Partners. Thank you very much. All right, back to the markets and sort of what led the latest decline within the equity market and the rally in the bond market is the consumer confidence data that came out. Mike McKee, international economics and policy correspondent, joins us here in studio. Mike, can you walk us through? I mean, we were already selling off in the equity market. We were already rallying in the bond market, but this was like kind of throwing water on a fire? No. Ashes on a fire, wood on a fire, gasoline. There we go.
A fire. I mean, we sold off on Friday because consumer sentiment in the Michigan survey was bad. This is 2 in a row, and that's a little bit scary because it's not just that there's been a little bit of a decline. There's been a big decline in both of them. This is the biggest decline since 2021 for the conference board number, and the expectations index is now at 72.9, and it's the first time it's been below 80, which they say is a recession sign since June of 2024. And the reason it did then was when Joe Biden was dropping out of the race and everything was kind of crazy. So this is overall a pretty terrible report. The jobs numbers in the report suggest that people are losing confidence in their ability to get jobs, in the number of jobs that will be available in the future, and their potential income going forward. And all signs that you could see a pullback. Now, it's well known that people's spending habits don't necessarily follow the confidence figures that come out, but it is something for people to worry about.
All right, so we've got potentially a confidence issue, potentially, a growth, I guess, question mark that maybe it's a little bit bigger than it's been recently. And then on Friday, we're going to get some inflation data here. What do you expect to see here? I'm looking at the consensus. Doesn't seem to be any pickup in inflation in terms of the consensus forecast.
Yeah, it's going to be the interesting thing because the CPI this past month was not good, and PPI also added to those feelings. But the way the PCE is constructed, the inflation gauge coming out on Friday, that is what the Fed follows, it's probably going to show a little bit of softness, and it's going to come down the core to 2.6 from 2.8. Those aren't record lows, but it is progress in the right direction, which is what the Fed is looking for. At the same time, the Michigan inflation numbers have gone up both for significantly for the 1-year number and also for the 5 to 10 year number. And then today, while the Conference Board numbers aren't considered as reliable because people seem to pick numbers really weirdly, they also went up. People now think that inflation over the next year is going to be 6%. Now, that's a little bit high comparatively, but it does show that people are thinking that inflation is going to get worse.
Boy, if I were an economic advisor to President Trump, I might be saying, can you tone it down on the tariff talk a little bit? Because I think that's starting to come into the numbers if you look at some of the survey data.
But is it? But Republicans are not even really showing, maybe a little bit of confidence decline, but it's mostly in Democrats and independents.
Well, true. We don't have a partisan breakdown in the Conference Board numbers. And this is a quote from them. There was a sharp increase in the mentions of trade and tariffs back to a level unseen since 2019 when the president was putting on tariffs. Most notably, comments on the current administration and its policies dominated the responses. So that appears to be sort of from both sides. And it is obviously something that people are worried about. So we need to keep an eye on that. Break-evens have gone up a little bit in the markets, but the market sell-offs we've seen have been limited. I mean, they are going down, but they're not falling out of bed. So whether the president wants to pull back or not, his comments have all been full speed ahead.
Yep, absolutely. All right, Michael McKee, thank you so much. We appreciate that. Michael McKee does all the economic stuff for Bloomberg Television and Radio. Joining us here again, we had the confidence. Just to repeat the numbers, consumer confidence number came in at 98.3. That was compared to a consensus of 102.5. So a big miss there. And then from last period was revised higher to 105.3. So the delta from last month to this month, 105.3 down to 98.3. That's what gets a lot of people's attention there. So we'll keep an eye on that, certainly. But it's certainly having an impact on these markets here. S&P 500 off 63 points. That's 1%. The NASDAQ off 370 points. That's 1.9%. We'll have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We are being brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centric support and future-ready technologies. Grow on your own terms with a partner dedicated to your success. Go to commonwealth.com to learn how. Major stock averages right now, they are lower and Treasury yields are higher. The S&P 500 lost about, right now, just over 1%. And a gauge of the big tech stocks dropping into correction territory right now. This comes ahead of NVIDIA's earnings. We get those after the close of regular trading tomorrow. Money markets now fully pricing in 2 quarter-point reductions by the Fed this year. The Conference Board's Consumer Confidence Index, we heard about it from Mike McKee, posting the largest drop in more than 3 years. And Bloomberg Economics attributes the sharp fall in confidence to doubts about the White House policies like tariffs. Still, as far as the Federal Reserve goes, Stephanie Roth at Wolfe Research says, you know what, she believes they're in no position to actually cut interest rates.
It's going to be a tough environment for the Fed to cut. I get that the narrative right now is this softer data. Some of this has to do with the federal layoffs, which have started to play out pretty significantly, but also some of the seasonality in the data. And I think this is what could easily reverse in the next couple of prints.
Right now, the S&P 500, 60 points lower, 59.22 on the index. The Dow Jones Industrial Average, 90 points lower. And the NASDAQ 100, 357 points lower. That is a decline of 1.7%. CoreLogic reporting home prices heated up in December, rising almost 4% from a year earlier. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, John Tucker. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. We also love checking in on the Bloomberg Big Take. It comes out every day, and it is a true in-depth story on the pressing issues of our time. And today's Big Take focuses on the bond market and Elon Musk. Is there anything more relevant than those two things put together? Enda Curran is a Bloomberg Global Economy reporter, and he joins us now on this. Now, Enda, the story is really about how the Treasury market can offer grades, in essence, for Doge and Elon Musk and his cost-cutting efforts. Can you guys walk me through what you found out?
Sure. Good morning, Alex. Look, on the one hand, obviously there have been very big headlines on the aspirational savings. Elon Musk talking about 1.2 trillion, then maybe downgrading to 1 trillion, but still huge savings, public spending money. Within that, since Doge got up and running, we've had the pronouncements that they've identified maybe around 55 odd billion worth of savings so far. But the point is that the bond market reaction maybe hasn't been as aggressive or has been more subdued than you might have expected to when you're talking about spending cuts of that scale. The 10-year yield, for example, is in that range of 4.3, 4.7%. And that's what we looked at today, how on the one hand you have these big headlines, big pronouncements on spending cuts and savings, and yet on the other hand, yield reaction hasn't been as aggressive as the headlines. And that's where we're asking, is there something of a mismatch going on there?
So the Doge team is talking about some, $1 trillion target cuts to spending. We've had a few weeks here to digest this and maybe look at some numbers. Is that even doable? Because it seems like so much of the U.S. budget is some of these fixed cost things that are really politically almost impossible to change, like Medicare and so on and so forth, and defense and those types of things. What's the belief now?
Yeah, look, obviously there's a debate. Should you be targeting payrolls? Should you be targeting areas that congressional reports have already identified where there is, for example, say fraud and waste that has already been identified? Or should you be digging deep into the world of entitlements and, as you mentioned there, Pentagon and defense spending as well? But right here, right now, in terms of the announcements or the pronouncements on the Doge website, etc., 55 odd billion is the figure. There's a lot of skepticism around that figure in terms of how much of those savings are actually real. Even if it was real, that would only represent 1% of the total budget, a $7 trillion budget. So those, savings are a drop in the ocean compared to what's happening with the fiscal deficit and with debt overall. So there is skepticism that the current
trajectory for the Doge cuts of focusing on payrolls isn't necessarily going to be enough to turn around the fiscal story. Now, to be clear, that if you leave aside the politics and the ideology, lots of people on both sides of the divide make the point that the fiscal trajectory needs to be fixed, it needs to be repaired, and so some tough decisions will be needed to be made at some point.
Yeah, exactly. Maybe not the method, but the idea important there. In theory, how sensitive do you guys feel after doing all this reporting is the Trump administration to the bond market?
They are sensitive. I just came from an event, by the way, where Treasury Secretary Bessent was speaking. He made the point that he's particularly focused on the 10-year yield. So they are watching yields. That's the benchmark that sets borrowing costs for the economy. So we do know that they want to see a dividend coming back out of this. The point that we're making in the article is that so far, despite very aggressive pronouncements, very aggressive interventions in some agencies and some parts of the federal government, that the bond market hasn't been especially overwhelmed by the news so far. It's taking it pretty cautiously, pretty steady. Now, our own Anna Wong of Bloomberg Economics makes the point that, however, if Doge continues on this path, maybe at some point later this year, we might see the view that the market views these cuts as quite material. They are digging deep into public spending, and that there will be a reward in terms of the market and term premium as a result. Doesn't feel like we're there yet, but certainly a lot of scrutiny on where this Doge process does go from here.
And President Trump has always been someone who does pay attention to the stock market. Is it going to be a challenge for Treasury Secretary Bessent, Elon Musk, to maybe have him focus on perhaps the bond market, the 10-year Treasury?
Well, what they're trying to pull off right now is a huge juggling act. To be clear, the administration says what they're doing is tackling the deficit. They're going to generate investment and growth by bringing taxes down and putting tariffs up on imported goods. And they say that's going to unleash the animal spirits through the economy, deregulation, energy, and the like. But right here, right now, even if you allow for that, we're certainly going through something of a pain period, and whether or not it's just a phase or something bigger, we don't know. We're seeing the dent in consumer sentiment. We're seeing some volatility now starting to creep into financial markets, the stock market response to some of these pronouncements. And, there's commentary too that these public sector job cuts may start to appear in the payrolls over coming months. So it does feel delicately poised that, yes, the administration said